Hello, my name is Tracy Williams. I will be the instructor of this course in credit risk management. So this is an introduction to credit risk management, but we're going to cover many different topics. Most of you, when you think of credit risk, one of the first things you're thinking about is that I am an institution, I make a loan, and then what is the risk of non-payment? So traditionally, let's think of this as loan exposure, for which we lend to a corporate borrower. And then what is the risk of non-performance and what is the risk of non-payment? When it's a loan, we're usually talking about the amortization of principal payments and also interest. So in this course, we'll talk about the probability of non-performance and non-payment as it relates to loans, loan exposure, in terms of principal and interest payments. Credit risk actually goes beyond just loan exposure. We will cover that in this course. That could also, credit risk can also arise as a result if when we buy a corporate bond, corporates issue bonds to fund themselves, and they also make interest and principal payments. It even goes beyond bonds and loans because it could also assume, it also means counterparty credit risk. This is where two institutions, maybe a bank, maybe a corporate, they engage in financial transactions. Could be a derivative transaction, could be an interest rate swap. There's credit risk in a financial transaction when there is the risk of a or probability of non-performance in that type of transaction. So in this course, we will define what credit risk, the different types of credit risk, the different forms of credit risk, different structures. We'll try to understand how does it arise in the forms of exposures, outstandings. That's also what we call credit risk commitment, a requirement, a contractual requirement to enter into a credit-related transaction. We think of that commonly, a bank enters into a revolving credit agreement with a corporate client, and even though we don't fund the loan initially, there's a contractual commitment for the bank to provide the funds. Of course, there's also contractual commitment of the borrower to pay principal and interest as scheduled. We'll go through some basic topics of credit risk. When we say basic topics and concepts, I had mentioned there's the risk of non-performance, there's the probability of a default. What is a default when a corporate, when a counterparty doesn't meet what's required? What actually happens when there is a default? Is there a remedy? What steps do we take if there is a default? Also in this course, we'll look at credit markets. We'll look at trends, especially over the past year when we had a global recession and we were going through the pandemic. So we'll take a peek about what's been going on in credit markets. How do credit markets measure credit risk? And then sort of bring us to the point that we are right now. Lastly, what we'll also do is cover portfolio risk management. So this is not looking at a single name. This is looking at a multitude of names, not one loan in the portfolio, not the analysis of one loan, but the analysis of a portfolio. And so we try to detect credit risk in the portfolio, and we'll go over some basic concepts and approaches to how do we detect credit risk in the portfolio and also quantify that risk. And then we'll end this particular course in a discussion of reducing credit risk. We call that credit risk mitigation. How do we actually go about reducing, eliminating, transferring credit risk? And so we'll go through the methods and common approaches that are related to that. First, let's go through the first, let's walk through some of the lessons and some of the outline that we're going to take, especially as it pertains to Module 1. So on the screen here, as I had said, this course will go through 3 modules. Module 1, mostly principles and concepts. Module 2, this is where we'll look at trends in the marketplace. We'll also look at what is called market indicators. That's where we look at bond markets, derivatives markets, credit markets, equity markets, and try to get some sense of their perceptions of credit risk as it relates to certain names, certain borrowers, and counterparties in the marketplace. So as credit analysts and as credit risk managers, we do analysis, we look for signs of deterioration, but we also can take a peek in terms of the perceptions of the marketplace and to at least look for consistency. Is there consistency in how we're looking at a particular bar or a particular name? And then module 3 will cover portfolio management. So in our objectives, I'm going to go through this very quickly. We're going to try to understand some of the conventional concepts of risk management. There will be the concept of what we call expected loss and unexpected loss. When we talk about credit risks, we do talk frequently about what is the probability of non-performance. What's the probability that the company cannot pay that interest on time? What's the probability that you cannot meet a principal payment on time? We will look at, of course, I said, through the marketplace. We'll look at market indicators. We'll introduce the concept also of credit default and credit deterioration. So credit default it relates to non-payment, specific non-performance. Credit deterioration looks at over a period of time, does the borrower or counterparty, is its financial condition withering? Is it deteriorating so that its probability of non-performance or probability of default is increasing over that period of time? It hasn't defaulted yet, but the probability of what is the deterioration? We usually call that migration of credit risk from a stable state to a worse state. We will introduce this concept called credit VAR. So this is credit value at risk, and that is tied to credit deterioration. And that is one metric of trying to measure how much can we lose, what is the potential loss in a portfolio as it relates not to default, but to deterioration. And then as we had mentioned that we're going to go through portfolio risk management. How do we detect the risk? And then also how do we measure how can we mitigate that risk in terms of reducing our exposure? Now, when we're also going to go through, we want to make sure that we talk about the different types of risk. I've been talking about loan exposure. So there's loan exposure, there's committed exposure, there's counterparty credit risk exposure, there's something called settlement exposure. So we'll go through the different categories of risk, and then we'll try to define them. So any type of exposure could very likely be mapped to one of these general categories. And how we analyze exposure, is also linked not just to the probability of default, but the type of exposure that we have as well. Then we'll talk about, and we'll introduce the concept of structuring exposure. Is it collateralized or is it non-collateralized? Is it secure? Is it unsecured? Is it long-term exposure? Is it short-term? Is it senior or junior? So we'll talk about that concept, senior versus junior. So that relates to when there's a liquidation or an insolvency, how will the company use its scarce resources to pay out what's due? And that's usually based on a ranking, seniority, junior, and subordination. As we had mentioned, that what we're going to do is we're going to try to quantify credit risk as much as possible. So module 1, concepts and principles, that is highlighted here. Module 2, default trends and market indicators. And those are the topics that we will cover. And then module 3 is credit portfolio management. What is the purpose of analysis? What is risk? What is credit risk? What is the purpose of analysis? And so in large part, what we do is that we try to identify the risk, try to understand the risk, but then how do we actually analyze that risk? And our objectives in lesson 1 So we will go through the basics of credit risks and credit risk exposures and financial products that involve credit risk. As I say, traditionally, we think credit risk, we're talking about making a loan or buying a corporate bond. As I had mentioned, that can arise, credit risk can arise in so many different ways, not in just the conventional or traditional ways as well. So we'll try to categorize that risk and define it. And as we had said, one of the first things we do is credit risk management. We try to analyze that in terms of analyzing who is our counterparty. Who is that obligor? Who's the borrower? Who's the client? Who is the entity? What is that entity that actually owes us money or has an obligation to perform? And so normally what we do is we do a financial analysis of that particular borrower. We want to understand the financial condition. So the details of financial analysis are out of the scope of this course, but what we'll talk about is some of the basics of what we're doing. Why is there credit analysis? What are we actually doing? So we won't get into the details of analysis, but we'll talk about scoping out what should analysis do. I want to understand, is a company performing? How well is a company performing? So it will increase, or I can predict with meaningfulness, what that probability of default is. Now, what we do is that when we do an analysis, we then summarize that analysis in terms of a credit rating. And that's what we're going to cover also in lesson 1. So as we had said, credit analysis involves a lender and an investor that has a relationship of some kind with a borrower, issuer, or counterparty. So we're starting with, I have a lender, and that lender has a relationship with a borrower, issuer, counterparty, or client. So it involves two parties. I have credit exposure, and then of course I want to make sure that I want to make sure that I have a high probability of payback, a high probability of meeting all principal and interest payments as scheduled. Now, the relationship between the borrower and lender, of course, exists within the operating environment. And so the operating environment will have impact on the borrower. It also have impact on the lender as well. So when we're analyzing, and I'm speaking from the point of view of the lender or the investor, I have to analyze the borrower, but then also I have to analyze the operating environment, the credit markets, the macro economy, and to the extent that could have some impact on me, but it also can have impact on the borrower as well. So credit analysis allows us to gauge, A, should I do the transaction? And if I do this transaction, how should that transaction be structured? And so to help us understand, should I be willing to take on that credit risk, of course, we perform credit analysis. So very, very formally, credit exposure arises because of the risk of non-performance and non-payment. And so I have the relationship between the borrower and the lender. And as I say, it can not only be the borrower, let's also say that it can be the counterparty, it can be the client, it can be a guarantor. If it's a guarantor, I can make a loan to the borrower, and then the borrower is guaranteed. So this introduces a third party, at which point in time I need to analyze, can the guarantor assure that there will be payments of principal and interest? So no matter what type of exposure it is, what I'm going to do is that, how does it arise? Now, initially it's going to arise because I agreed to do a loan. There could be other ways that it could arise. If it's a revolving credit facility, I don't have the exposure until there's a drawdown under the revolving credit. And then we're going to say, how do we analyze that exposure? How do we measure what the exposure is? And how do we monitor from a period to period? So very, very easily, we can think of this as, I make a loan for $1 million. And then I analyze how, before I make the loan, I'm going to do an analysis to make sure that the borrower is creditworthy. And then throughout the time of the borrowing, I'm going to try to measure that risk, and then also measure the likelihood that the borrower will perform on that. And so we analyze it, we measure it, and we monitor it. We also structure it at an outset. And so when I say structuring, that means if I make that $1 million loan, I have to determine the terms of that loan. Long-term, short-term, 3 years, 5 years, 1 year, 10 years. I also have to understand, should I require collateral? And so certain situations, and we will get through this and in the other modules, will understand that I will only be able to take this risk if I can manage or reduce this risk by having a resort to another source of payback, and that would be, say, for collateral. And then when I make that loan, during the life of the loan, I might say, how can I reduce it, transfer it, or eliminate it? Can I do so? I make the loan, I put the loan in the book, I have the exposure, I have the risk. Is there some method? Is there some tool of being able to reduce that risk as we go forward? So we're starting from the beginning. Right at the beginning, as I said, we need to understand who that counterparty is, and that's going to involve analysis. As I had said, what we're not doing is that this is not a course in how best to do the analysis. It's trying to understand the importance of doing analysis when we have credit risk. And so traditionally, we have a credit analysis presentation, whether we're talking about a group of debt investors, or bond investors, or a bank. We do credit analysis, and that's really financial analysis along with another factors. And so what we're trying to do is reach a risk decision. Should we take on the risk? Should we take on the exposure or not? So this is credit risk as opposed to, say, a market risk or liquidity risk or other types of risk. This is, should I take on that obligor? Should I take on that borrower? So traditional credit analysis usually involves a certain amount of financial analysis. How strong financially in terms of its operating earnings, its balance sheet, is that obligor? Is it strong, very good, weak, or poor? And that's going to help me lead to my risk decision. To the extent that it is weak, I might be less inclined to do that exposure or grant that exposure or do that particular loan. But as I said, it also involves the operating environment as well. So what I will do is I'll analyze the borrower, but I also want to understand the operating environment, the macro economy, the sovereign risk, the country risk, the legal risk. I want to understand the context or the scenario in which I am doing this particular loan. And then I'm going to combine that with a number of other factors. I'm going to go back and look at lessons in the past. I'm going to look at history. I'm going to sort of look at my own experiences. And I'm also going to use common sense and judgment to kind of come up with a risk assessment. We're going to come up with a risk assessment. And in this course, where we talk about that, we talk about the ultimately what we like to do in the world of credit risk management and credit analysis is come up with a rating. Now, most people are aware that a rating is something that Fitch, S&P, or Moody's will offer. So Fitch, that's what they do, is that they provide ratings for obligors, for companies that can help us understand the risk of non-payment or the probability of default. The vast numbers of borrowers and obligors and counterparties don't necessarily have ratings. So as institutions or banks or lenders or investors, sometimes we have to do our own analysis and come up with our own judgment. But we still come up with an overall assessment. The rating agencies, as I said, use an alphabet rating, AAA, AA, single A, all the way down to triple C, C, double C, and default. Banks may use a numerical rating, 1 to 10, 1 to 18, 1 to 8, 1 to 24. And so they summarize that entire financial condition with a rating. And then from that, we take the rating, triple B, double B, on a 1 to 10 scale, 5, and then we translate that into a strategy. Do I want to take on this exposure? Am I willing to take a risk? And then, as we had said, ultimately what this does is helps us make a decision. Do we do the transaction? Do we do the loan? Do we buy the bond? So credit risk management helps us make credit risk decisions. So this is summarized here. So part of risk management is that we do the financial analysis, We look at the deal, the transaction, the bond purchase, the loan structure, the counterparty. What are the requirements? What are the commitments? We come up with a rating, and then we talk about a strategy and outlook. So the risk strategy and outlook is going to be very much directly tied to our analysis and rating. And the strategy can be, I want to do more business with this client or obligor. I want to do more transactions or trades with this client or obligor. So we can expand the relationship, we can increase the relationship, or we might want to say, let's keep it flat. Or if we're concerned after we have done the analysis and come up with a rating, we can actually say that we want to reduce. In some situations, we may say we want to get out, or in some situations, we don't want to onboard this client or counterparty. So analysis helps us come up with a rating and then comes up with a strategy as well. Another aspect is outlook. So what we want to do is we look at history, we look at the past, but what we would like also to do is have some projection of the future. We want to be as forward-looking as possible. So a lot of our understanding of financial performance is going to be based on historicals, but we want to consider what is the outlook in the industry, what is the outlook in the economy and in the operating environment as it relates to today, and then we might want to adjust our decision making or even adjust our ratings to the extent that I want to make sure, yes, I have accounted for history, but I want to make sure that I also have an outlook for the future as well. And then, as I had said, ultimately what we're doing is we need to make a decision on a client obligor, a borrower, or a specific transaction. A transaction deal, an investment opportunity is on the table, and I want to be able to make a decision about that. So as we had said, credit analysis, what does that involve? And as I keep reminding ourselves and you, I remind ourselves that we're not going to really get into the details of how do we analyze the balance sheet? How do we analyze working capital? How do we analyze the cash flows and revenue streams of a particular company? How do we analyze all the financial ratios? What I'm trying to do here is help us understand why we need to do this, And so what we're doing is, as I had said, we're assessing the probability of performance. But if we take one or two steps back, what we're trying to understand is that can the borrower achieve a sustainable and stable financial performance from period to period to meet all obligations, not just mine, if I'm a bank or if I'm an institutional lender or a bond investor, not just mine. I want to make sure that it is solvent. Can it operate on an ongoing basis smoothly and with high probability of performance from period to period? I also want to understand to the extent that from the performance, after having done the analysis, can it generate cash? And so a lot of our financial analysis ultimately is an assessment. How much cash does the company have on its balance sheet, or how much cash flow can we project and predict will come on into the operations and come into cash reserves to be able to use principal and interest for purposes. And so ultimately, when we're talking about performance and we're talking about making sure that there's a high probability, high predictability of principal interest payments, ultimately it's about cash reserves and cash coming onto the balance sheet, or cash flow. So analysis is going to focus on operating cash flow and cash reserves. Then, as I had said, I'm forward looking. I want to make sure that despite or no matter what has happened in the past, and yes, the past has really helped to get a sense of how well the company is doing, I want to project and predict how will it continue to perform, or is there a continuing high probability that it'll meet its payouts in the future. And then ultimately, having done the analysis, having come up with a rating, I can actually try to project what is the probability that my loan will go into default. So I do all the analysis, I come up with a rating, and then I actually can sort of say, okay, based on that rating, what do we think? What do we think is the probability of non-performance or probability of default? Now, as I said, later on, what we'll do is we'll talk about if there is a loss, what can we do? If there is a default, how can we minimize loss? If there's a default. So we reach the point where the company cannot make that principal payment when it's due, and we actually give them some time to be able to make that payment. And then at some point, what are the steps that we take? And then how could we sort of recover parts of the loan? So part of our analysis and looking at the structures and exposure will include that, okay, the company did go into default. Now let's make sure that we can recover as much of our loan as possible. I make a loan for $10 million. I buy the bond for $50 million. It declares, it goes into default. We go through what we call an acceleration. That could lead to bankruptcy, but there's still a possibility in recovery. What can we recover? So that's my loss given default. What is my loss given default? Now, another thing that's credit analysis helps us, because credit analysis allows us to do a rating. It allows us to do a rating. We can therefore price the loan. We can price the risk. And so we'll talk about this later in terms of risk versus rewards. Debt investors, lenders, credit counterparties want to be rewarded for the risk that they take on. And so usually we think of that in the concept of a spread, a loan spread, a bond spread. And so we'll talk about that because we want to be rewarded for the risk. Now, normally, if it's a bond or if it's a loan, it's going to be an interest rate. So how do we determine what the appropriate rate is? How do we determine what the appropriate interest rate is, which also gives us a reward for the risk that we are actually going to take? So analysis is going to help us determine at least more precisely what we think, what we deserve is the reward for the risk that we are taking on. And so, of course, analysis will also help us determine that at some point after the loan has been booked, and say if it's a 10-year loan or a 5-year loan, the money is out the door. Is there credit deterioration? We continue to do the analysis. We do updates. And is there deterioration? Is there an increasing probability of default? And then therefore, if risks are increasing, what can we do? What can we do? So the analysis will tell us that the risk is increasing. We probably need to do something: hedge, reduce, sell off, transfer the exposure. The analysis will also help us determine the rating, but it'll also help us determine that we might need to structure this loan that such that it's short-term versus long-term. We need to structure this such that it is amortizing in terms of principal payments, not necessarily what we call a bullet payout or a balloon payout. I make a loan for 10 million. I want a little portion. I want some portion of that principal to be paid down every single year, as opposed to a 10-year loan for which no principal is paid until the final expiration date, and then I get interest during that period. So the analysis is going to help us determine the rating, which is going to help us determine the type of structure that we think is appropriate for a particular loan. So as we show here, here's that I have a borrower. It has obligations to pay, obligations to perform. I have lenders. And those lenders and investors and counterparties, they're different types of products. Some of them we'll outline in this course. I just talked about pricing. We will talk about what's the appropriate amount of pricing. Should we have collateral? If there is an insolvency, how is the bankruptcy judge going to arrange for payout? So that if the total debt on the balance sheet could be 100 million, the company has filed for bankruptcy, there might be 50 million in cash on the balance sheet. Well, who gets the cash? Who gets parts of the cash? Who gets all of the cash? And that's what we talk about when we talk about waterfall arrangements. And that's very important because oftentimes I want to make sure that I am senior enough such that if there is an insolvency or liquidation or bankruptcy, that I'm at the top of the waterfall and not necessarily at the bottom of the waterfall. If I agree to be at the bottom of the waterfall, I want to get rewarded for that in terms of pricing, in terms of the interest rate. So as we had said, we analyze the financial condition, and that's going to help us make a lot of decisions about how we do the loan, whether we do the loan, and then how we actually structure that particular loan. Now, when we do credit analysis, we often present an argument. It's a presentation. It's rationale for why should we do the loan. And risk managers, credit analysts, what they should do is try to present a very thorough, comprehensive, well-integrated financial story. So this is where we have a lot of numbers, right? A company will have earnings, it will have cash flows, it will have balance sheets, assets and liabilities, it'll have equity, have financial statements, it'll have accounting reports, supplementary information. There's a lot of information. And so we digest that information, but ultimately what we're trying to do is, what is the financial story? Is the company getting better? Is it deteriorating? Why is it getting better? Is it controlling costs? Is it expanding in certain markets? When cash comes in, what does it do with the cash? Does it pay down debt? Does it prepay debt? Does it reward stockholders with dividends and buyback and share buybacks? Or does it reinvest it? So what we're trying to do is that analysis is just not about sharing the numbers or repeating or regurgitating numbers. Analysis is about understanding what the story is all about. And so it's not about numbers go up and down from period to period, from year to year. It's about what is in essence going on with this particular company. So this particular company, it may not be growing, revenues could be flat, but its costs could be declining as a percentage of revenues, and therefore profits are increasing, not because of revenue growth, but because of improvements in cost control. All right, earnings translate into cash flow, and that cash comes in. What is the company doing with that cash? Is it taking on? Is it buying back stock? Is it paying dividends, or is it reinvesting? Or is it choosing, if it thinks interest rates are going to increase, is it choosing to pay down debt, prepaid debt, if it can do so? So analysis, as I said, is not just about numbers. It's also about standing back to understand the story. What is the story, and how that story is going to be reflected in a risk rating or a credit rating? So the analysis should be convincing. It should be rational. It should make sense. It should take a look and take a peek at the past. It should be quantitative, but it also should be qualitative and forward-looking. So let's make sure that as we understand the role of analysis, we understand that I want to understand the integrated financial story as opposed to movement in numbers from year to year. Movement in numbers. I want to get the essence of what's going on. Now, as I said, this course is not about how do we do the analysis. It's about what I want to see in an analysis and how important the analysis is in helping us manage and also understand credit risk. And so usually in an analysis, if it's a company, our borrower, what we want to see is that what industry does it operate? What is the business model? So I have a counterparty. That counterparty could be an airline. It could be a high-tech company. It could be a social media company. It can be a consumer products company, or it could be a bank. I want to understand the business model. What is this business environment? How does it make money? How does it generate operating cash flow from period to period? What are the risks? What are the threats? What are going to be the threats to performance from year to year? So that argument is going to have to tell the reader or the respondents or the loan committee what the operating environment is and what the threats are. Then we get into an understanding who's running the show, who is the management, what are the expectations of equity investors? What are their business strategies? Are they thinking and contemplating of expanding abroad, getting into other markets, penetrating other markets? How does this company try to differentiate itself from some of its peers and competitors? Then, as I had said, we get into that financial story. That's the profits and earnings in the operating cash flow. That's the assets and the liability and the working capital, the fixed assets, productivity, cost control, operating profitability, returns on capital, and debt to equity, debt to EBITDA types of metrics. Now, that's not covered here, but it helps us understand how we take that information to sort of form that integrated story. And then ultimately, as I present this very logical argument, I can fairly smoothly come up with conclusions and recommendations and that all important rating. As I say, that rating is important because it's going to help us structure, it's going to help us make a decision about whether we should do a transaction or not, but it's also going to help us in terms of how do we price the credit risk. That rating is going to help us understand what should be, or what do we think is the probability of default, and how should we price that risk. Now, in the loan world, in the corporate, it could be the risk-free rate plus a credit spread, LIBOR. That is the traditional form for corporate loans pricing, LIBOR rate plus a credit spread. Now, I'll say this as sort of an aside. LIBOR is eventually going to go away and be replaced by another metric. But we have a base metric in terms of interest rate, usually it's the cost of funding the investment, the cost of funding that loan, plus a spread. So that's my reward, but my reward is going to be determined based on my analysis. So as I had said, when we do analysis, we assess the creditworthiness. We want to understand the ability of the borrower to make future contractual payments. The analysis is going to look at all the different types of activities and the operations, and then come up with these types of conclusions. And we can use that analysis to come up with a rating, and it's applicable to all types of credit risk, not just what I've been talking about, loan risk and bond risk, but risks that come up from other types of financial activity as well. Counterparty trading, cash for banks, it would also be financial processing and cash management activity. Credit risk comes up in those activities, and then I can use my analysis and rating to come up with a posture of how I will manage that risk, how that manage the risk. Now, when we think of credit risk and also credit exposure, we say, how can a company or obligor pay us back? And so what we would do is we try to identify what is the major source of payback, and then primary source of payback, and then what is the secondary source of payback. Now, what we want is we want to make sure there is a sufficient amount of primary source of payback. Traditionally, for companies that will be operating earnings and operating cash flow, a secondary source of payback could be a guarantor, a third party, or the company has to sell off certain investments and fixed assets to raise the cash to be able to pay it back. Now we accept that. Now I have a loan, I will accept that as a form of payment, but I want to see the company being able to pay down debt, to handle all of that credit exposure from primary sources of payback, primary sources of payback. Now, in credit analysis, we look at a corporate's balance sheet. As I have mentioned, we're not going to go through this in depth. I'm just trying to define what do we tend to look at as we approach doing the analysis. And so on a corporate balance sheet, very typically, that credit risk is going to be in the form of short-term debt and long-term debt. And so as an analyst or a risk manager, I want to know what is the company doing with the proceeds of that. So what is the purpose? Are they taking on short-term debt to fund working capital? Are they taking the long-term debt to fund fixed assets, infrastructure, plant, property, and equipment? But I also want to know, sometimes companies take on debt and they borrow to be able to buy back stock and pay dividends, to expand in foreign countries. So I want to get a sense of what are they actually using the funds for? And that's part of the analytical process. The different types of debt, later we're going to summarize that. And then how is that debt going to be serviced? Of course, that's going to be related to principal interest payments, and they're going to be scheduled over a period of time. And as I just talked about, is that I've got the debt, and I've got the loan, I've got the credit exposure. It now appears on the balance sheet. Now I want to know what are the sources of how they're going to come up with that payment. Again, that's part of the credit analysis for the analyst to kind of identify what those primary and secondary sources of payback will be. Also, in credit analysis, debt investors and lenders rely on cash flows and assets to ensure obligations will be paid as scheduled. We just talked about that. So on a balance sheet, this is my corporate balance sheet, and it's cash that's going to be used to be able to pay down principal and interest or any type of obligation. It could be accounts payables to suppliers. It could be accrued expenses, could be other forms of liabilities, could be taxes payables. So cash is going to be, of course, obviously, it's going to be the primary way of paying it down, but it's going to be also operating cash flow. That's over a period of time. More cash will come onto the balance sheet. It can be used to pay down long-term debt, but sometimes companies will take that cash that's coming in, as I had said, they're actually going to pay down, they're going to buy back equity stock, or they're going to pay dividends, or they might reinvest it. That goes to my financial story. So from quarter to quarter, from month to month, from year to year, what is the company actually doing with that cash that's coming in? Credit analysis, as I said, when we look at operating cash flow, that's from the performance. We also look at the debt that's on the balance sheet, and then how that operating cash flow is going to service the debt. That operating cash flow is also going to be used to pay suppliers and expenses. Oftentimes for corporates, when the debt comes on, it's going to be refinanced. Now, as a lender and as an investor, I know that my debt is going to be serviced from operating cash flow. Interest payment is going to come in from operating cash flow. But I know that oftentimes what happens is that companies don't pay down debt, they refinance it. And so operating cash flow will come in. And so debt will come in and it will fund this, but then that new cash is going to come in and to be able to service that debt on an ongoing basis. Keep in mind also, companies exist to provide rewards to investors. And so at some point, some of that operating cash flow is going to be made available to equity investors in the form of a dividend or buyback. So when we analyze a company, we're analyzing the financial performance, the financial condition, coming up with a rating, but we'll also understand that the company also has its eye out on the expectations of equity investors as well. Now, when we talk about types of exposure and debt funding, there's lots of different types of products that involve credit risk. And this is just sort of a summary. The sources of debt funding: revolving credit, confirmed loan, guidance loan, short-term, long-term, amortizing. That's a loan for which principal payments are made regularly throughout the life of the loan. A balloon payment, that's when the principal payments are not paid until expiration date. Syndicated bank loan, club loan, term loan A, working capital, corporate bonds, bridge loans, subordinated loans, convertible bond, a type of bond that is that at the discretion or at the option of an investor, they can convert that into stock or equity. We have bonds with warrants and private placements. So now, we don't have time in this course to go through each one of those types, but it shows you for all the exposure that a company can have on its balance sheet, this is the lending group, the financing group, for which there is a lot of credit exposure. For large global companies, they will have a little bit of all of these products on the balance sheet. Now, even for small companies, they will have sort of some of these sources: a revolving credit facility, a working capital facility, and maybe a term loan. But so what I'm trying to capture here is that what are the different types of products that have credit risk? A lot of these are loan products, and I'm focused on loans later. Now, later on, we'll talk about other types of financial transactions for which there could be credit exposure. And so credit analysis, this goes back to credit analysis, and we've talked about this already, or at least summarize it. What's the purpose of that debt? What are the proceeds? What is the reward for the investor, the pricing of that debt? What is the company's strategy in terms of managing that debt? How has the company managed its obligations in the past? Is the company vulnerable to deterioration? Is the company vulnerable to deterioration? Can the company take on new amounts of debt? Lots of companies are saying, we're going to expand. I need to take on more debt. That's part of the analysis of the balance sheet and capital structure. As it expands, it needs more assets, more investments. How is it going to fund it? I need to take on more debt. Credit risk management, credit analysis says, can help us determine, can it take on more debt? A company has $1 billion in debt. Can it take on $1.5 billion, $1.7 billion? And the analysis and ratings process will help us determine, is there the capacity to take on debt? So as I said, for the most part, what we do and when we manage that credit risk is that it is the risk of probability default. But a lot of that is going to be the probability of being able to come up with operating cash flow to be able to service that debt. So ultimately with a corporate, if there's loans, if there's a loan exposure, if there's a bond investment, short-term debt, long-term debt, it really comes down to what is the probability that the company will have cash reserves or continuing operating cash flow to meet all these obligations on an ongoing basis, So we're going to start summarizing here. Financial analysis, the benefits and deficiencies. Financial analysis helps us come up with that rating. And so we can look at a company's performance over time. We can look at it at a point in time. I can go back and look at it. How did that company perform in other downturns, economic slumps, or the previous recession? I can look at it in terms of understanding its business models. I can sort of also use analysis to project the company and also go through worst case scenarios. I can look for anything that doesn't look right, volatility in performance, uncertainty in performance. And then also, of course, this analysis is going to help me make my risk decision. The deficiencies, the pros and cons. The con would be is that we're looking at past performance. So sometimes analysts get too bogged down in what happened 5 or 6 years ago. And we need to be more forward-looking. Analysis of old information helps, but we got to make sure that how is the company going to perform in the periods to come? And that's where we use insight. We use insight, experience, and our understanding of the operating environment to try to project how the company's going to perform in periods to come. Another thing is that we got to make sure that we don't overlook qualitative factors. That's the environment, that's the legal system, the country risks, the business model, the competition. There are a number of qualitative management succession, management competence. And so there are a number of things you're going to make sure that we don't overlook. And sometimes the analysis is sometimes we get too bogged down in the old numbers and such that we forget to go back and look at qualitative factors. Credit analysis, as I said, in this course, we're not going to go through the details, but what it tends to cover, it will cover for a company profitability, operating cash flow, the assets, working capital, cash on the balance sheet, liquidity, debt capacity, debt burden, the capital structure, management. How is the company capable of going through a crisis? How has it fared in a crisis in years past? How does it meet its regulatory compliance obligations on an ongoing basis? And then what's the overall financial condition? So traditionally, when a risk manager or credit analyst or financial analyst is involved in analyzing to come up with a risk rating, it will have analyzed most of the relevant categories on this particular list, and then come up with an overall story and then an overall analysis. As I had mentioned before, there are rating agencies, the credit rating agencies, Fitch, S&P, and Moody's, most notably, that will provide a rating. And then as analysts, we separately will do a rating. Part of the reason we do the analysis is because the Fitch, S&P, and Moody's do not analyze every company. They analyze selected companies. And so we still have to have some capability of looking at companies that are non-rated. The conventional approach is to look at these different categories and then rate each category and then weight each category. So some categories, depending on the industry and the business, are weighted more highly than some of the others. And then we come up with one rating and then the outlook. And then, as I had said, that's going to help us understand the probability of default. Now, for the purpose of this courses, I'm looking at it in terms of a 1 to 10 rating. And then I kind of map a 1 to 10 rating with a qualitative rating, and then how that rating would be as it relates to the credit rating agencies. So if I do my analysis and it comes up with a 3, that might mean that it's somewhere between excellent, strong, and good, and that might map into a single A or double A rating with the rating agencies. Now, what we're going to do is that we're trying to derive a probability of default. So as we go down this rating scale, the probability of default will be high. Now you see the D rating or 10 rating, the company is already in default. It's in bankruptcy. So that's a 10. As we go down, the probability of default, that's how we measure this credit risk, will be high, Now, as we wrap up this lesson 1 of module 1, let's just take a quick look at some cases. This is Goodyear Tire and Rubber Company. So when I'm analyzing this company and looking at credit risk, I'm looking at the debt obligations. This is one way of analyzing credit risk of Goodyear, is that first of all, I want to know what are the debt obligations. This is where I have true credit risk. Goodyear has an obligation to meet the principal and interest payments on debt that is now $6.4 billion. As part of the analysis, what I'm doing is that I'm looking at trends over time. I see that for several years, Goodyear was pretty flat in terms of debt outstanding, and then it increased last year. So I want to know, what is the debt being used for? What is it really being used for? Now, quite obviously, for a company like Goodyear and Tire and Rubber Company, is most likely being used for plant, property, and equipment, renovations, upgrade, possible expansion. And then what are the sources of payback? It's going to be operating cash flow. And if they don't have sufficient operating cash flow, they might have to sell off certain assets or use cash that's already on the balance sheet. I want to look at the types of structure: secured, unsecured, long-term, and short-term. And then I'm going to go and look at the analysis of Goodyear to see, can it continue to make sure that it's going to meet the obligations on what we see now is an increasing amount of debt on the balance sheet. $6.4 billion. What is the likelihood that it can continue to make the principal interest payments? What is the probability that it might default on this debt? And then is there capacity to go to $7 or $8 billion in debt? Now, as I had said, most likely with corporates, what will happen is that debt will be refinanced. So Goodyear will say, when it's due, if I can, I'm not going to pay it all down. I'm going to try to refinance it. So therefore, I'm going to say, what's the likelihood that Goodyear will be able to refinance that debt from period to period? Here's another example of a case. It's Freeport McMoran. It is a commodity production company. Most notably, it is involved in copper mining and copper production, and it sells the copper into the marketplace. So similarly, what we do is that we look at the trends of credit risk or credit exposure. You can see that at one point it was 20 billion, and now they've brought it down to 10 billion. So the debt is in decline. And so as I analyze this, I'm going to see, how was it able to come up with that decline in debt? Did it use operating cash flow, cash reserves, or did it resort to secondary sources of payback to pay down that debt? And then I want to understand also, can the company to continue to perform in terms of operations, can it continue to sustain performance to be able to not just looking at the past, but going beyond 2020, next 5, 6, 7 years, can it continue to meet its obligations of principal and interest on that debt? And so that does mean that we've got to analyze Freeport, but we also got to kind of understand how will it look as we go forward. How's we look forward? Because there's $10 billion in debt on the balance sheet. As we said with corporates tend not to necessarily pay down all of that debt. They refinance significant portions. So my assessment will be, can the company refinance that debt? Can they refinance that debt without difficulty? Another popular company we can look at, it's been in the news quite a bit over the past several years. It has debt on the balance sheet. I asked, what's the purpose of that debt? Very likely, of course, for production purposes. We all know Tesla, of course, as the electric car company, and it's sort of ramped up aggressively production of electric cars over the last 3 or 4 years, especially in 2020. So a lot of the proceeds of that debt is to support the operations and plant, property, and equipment. And you can see that the debt has sort of gradually increased over the last several years. And so as I'm assessing that, as they're taking on debt, I want to make sure I understand what's going to pay the principal and interest on that debt. Now, we can say cash on the balance sheet, operating cash flow, or is there another source? Now, one source equity Tesla has used is that it has issued more stock. The proceeds of that stock, cash, has and can be used to put more cash on the balance sheet to get financial analysts and credit analysts comfortable with the increasing amount of debt that we see on this balance sheet. So now I've got to assess, is there room for Tesla to take on more debt? I've got to go back and look at the operation cash flow, the ability to grow revenues, the ability to maintain and manage costs effectively on a predictable basis. And so that's where I get inside the numbers a little bit more to assess what's the likelihood that it can perform, and then what's the probability that that debt might default. Now, let's wind up lesson 1. So what we've done is that we've gone through some of the basics of credit risk management, credit exposures. We've gone over a few debt products. We've talked about the purpose of credit analysis and financial analysis, why it helps us come up with a final credit rating, and then how that credit rating is mapped into a risk strategy, risk decisions, and credit structuring. We've looked at some of the analytical approaches to determining a credit rating: profitability, earnings, cash flow, balance sheet, debt, capital structure. And so in essence, what we really want to do is when we analyze a company is that, what are the resources to be able to pay down that debt? And we would like for that primary source to be operating cash flow. This concludes lesson 1. In module 2, we'll look at default trends and market indicators. What we're now going to do is sort of step beyond analysis and then look at data trends over a period of time to look at default rates. Do they peak? Are there clusters of default? Are there periods of stability? So we're going to look at this in terms of the entire corporate industries, globally, US, by certain industries, and we look at some trends. Were there periods in the .com craze when the default rates increase? What about the financial crisis of 2008, 9, and 10? What about default rates then? And then, of course, what about the pandemic and global recession of 2020? What happened to default rates? Now, we expect that when the operating environment deteriorates, when the macro economy deteriorates, or any number of operating environmental factors, it could contribute to increases in the default rates. So we do analysis, but we also want to look back, as we did in the first module, go look back a little bit more closely to see what's going on in terms of default trends among corporates over the last decade or so. We're also going to look at market indicators. Market indicators, as I said, is that you have bond markets and credit markets. You have credit models that are also looking at companies, not just the rating agencies, but other types of markets, and they're forming perceptions. They sort of have a viewpoint of possibility of decline or higher probability of defaults for certain names. I want to kind of get a sense of what they are thinking. That's not a substitute for analysis, but it can complement the analysis and risk management that we actually do. In some ways, a negative impact on the company by the market, the bond market, the loan market, the bank market, the equity market, the stock market, the derivatives market, that negative impact could shape the company as it goes forward. It could have impact to the extent that it might limit the amount of borrowing that the company can do as it goes forward. It might, and so that negative perception, even though it may not be realistic or fair, it could lead to certain problems in the future. Another, as I said, another reason why I like to look at market indicators is that other analysts, other traders, other investors and lenders might have a more acute understanding of the risk than I do, or a more conservative interpretation of the risk than I do. So if I rate a name a single A, Fitch rates the name a triple B, and the market rates the name based on probability of default a triple B minus, then I want to get some sense, what are they seeing that I am not seeing while I'm looking at the name at the same time? So that's how we use market indicators. Let's start with lesson 1. This is default trends and credit markets. So in lesson 1, we'll look at current issues and topics as it relates to global debt markets, including corporate default. We'll take a peek at what has been going on in 2020 in terms of defaults and bankruptcies during the pandemic. And then we'll look at some other periods of stress. We've seen periods of stress in corporate markets, debt markets, corporate exposures. We've seen that in the financial crisis of the mid-2000s. We saw that, of course, in the dot-com years of 1999 to about 2002. And then we'll try to see that whether defaults, do they occur in clusters? Is there some form of correlation? And see how we could project or predict, at least in markets, if not a name by name, when there could be a rise in defaults. We certainly saw a rise in corporate defaults last year. Could there be, how can we project a rise in defaults in the marketplace as we go forward? And then lastly, in lesson 1, we're going to look at credit deterioration versus default. So default is non-payment or non-performance. Credit deterioration is as we proceed from quarter to quarter, period to period, is there deterioration in the financial condition or an increasing higher default probability? Is credit deterioration is the company is still viable, it is still solvent, but the probability of default has likely increased, Now, let's look at some trends. This is going back over about a 40-year period, and you can see that whether this is in the US or whether it's global, that we do go through periods of peaks and valleys. And a lot of this is sort of, as I had mentioned, a lot of this is sort of defined by the global economy, the global operating environment during that period. If we go back to the early 90s, you can see that there was global recession during that period. We go through here and sort of up to the turn of the century. This is 99, 2000. I had called this the dot-com craze, but this is also where a period we had the Russian debt crisis. We had a foreign currency Asian crisis during that period as well. So it does appear that when we go through these, as we kind of look at what's happening in the marketplace, it does appear that defaults tend to kind of appear in clusters. This leads to the concept that we'll talk about a little bit more closely in module 3 is default correlation, the domino effect. So if every name, every exposure has a default probability. Well, what's the probability that they will all default at the same time? And that's what we talk about in terms of default correlation. So if one company, I can do the analysis, the default probability over 5 years can be 0.1%. Another company does do the analysis and the default probability is 0.2%. But if I look at this in terms of what's the probability that if they're correlated in some kind of way, that they can also happen at the same time, default clusters and a default correlation. Obviously, you see here that's the crisis of the mid 2000s, the global recession, the Great Recession, the financial crisis. And then if this were to extend out to 2020, we're going to see another cluster of defaults as a result of global recession and then the impact of pandemic around the globe. What we also see here, global, again, this goes back to my peaks and valleys. This takes into consideration a little bit more recent data. If we include beyond 2011, we can see that what helped cause defaults. Some of this is related to bankruptcy. Remember in the previous lesson in module 1, we talked about how do we define default. If it's certainly in bankruptcy, that would be a definition of default. And so you can see more specifically what were some of the reasons behind the default during this period. You can see that in 2009, a number of defaults were basically bankruptcy related. A number of defaults were actually based on missed principal and payments. Some of the defaults are also related to regulatory intervention as well. As we get toward 2018, 19, and 20, we now see, we see the recovery period after the financial crisis. And you see the recovery period after the financial crisis. And then we sort of get at the beginning of the crisis. So this takes us to 2020, but it's sort of the beginning of the pandemic crisis of 2020. In some cases, companies can file themselves. Let's keep that in mind. When we talk about bankruptcy, a company itself can file for bankruptcy to ask for reorganization. Its creditors can put it into bankruptcy as a part of the default acceleration after a missed payment. Or in other cases, companies might miss a payment of principal and interest, and that's a default, but it's not yet in bankruptcy. It is definitely a bankruptcy, and the bank's creditors can accelerate, but it's not yet in bankruptcy as well. That goes back to our definition of what actually constitutes a default. And that's what I'm emphasizing in this course is that when we have that declaration of default, it does give the corporate, it does give the financial institution, the lender, the investor, the right to take action. And then that action could lead to a renegotiation, a settlement, or an exchange of debt, or actual bankruptcy and liquidation. Let's look at these default trends in terms of non-investment grade versus investment grade. Let's keep in mind, investment grade as defined by the rating agencies would be BBB minus and higher. So that's the convention, BBB minus and higher from Fitch, S&P, and Moody's. And so you can see that default rates are expected to be lower for investment grade, in part because these are stronger firms, stronger obligations, more stable operations and earnings and cash flows. And also higher ratings do tend to have lower default frequencies, and then of course, lower default probabilities. We would expect, for all the reasons that we come up with the analysis of a non-investment grade name, what we call the high yield names, we would expect that to be higher defaults and higher defaults. So default probability, we're going to look at default frequency. So that's the takeaway from module 1. And this looks at a little bit more closely. The other charts show default trends, but now I'm going to start looking at this in terms of industries and ratings. And you can see that as we go through economic cycles, as we go from period to period, that investment grade names are subject to default, but they're not going to be as high as non-investment grade. Intuitively, we know this. In practice, it actually shows that. And so from year to year, our charts show that default trends fluctuate, but then they're also very much tied to whether they're non-investment grade or investment grade names. This is presented in very simplistic fashion. In practice, there could be some names that are borderline or have split ratings. What I mean by that, a name could be a triple B minus from S&P, but it could be a double B plus from Moody's. In one respect, it's an investment grade name. In the other respect, it's a non-investment grade. So there's some polishing of how we present this particular material, in part because rating agencies don't necessarily reflect the same rating. Now, as we can look at this over a period of time, this was looking at it from 2001, 2006, 2009. Now let's go from 2011 to 2015. And again, as we had said, that global default rates appear to be very much tied to global economies and the operating environment, but they're very much tied, of course, as we would expect, and the data shows this, tied to whether it's investment grade or non-investment grade. Investment grade names continue to perform as expected by the time we get to 2015, and they deserve the ratings that they earn. Note that in certain years, the investment grade default rate was actually 0%. In certain years, it's 0%. In certain years, it could be as high as 0.03%, as you see here, or as high as 9%, as we saw during the Great Recession in 2008 and 9. So overall default statistics may also reflect declining performance of one or two significant large borrowers. What I'm saying here is we're looking at data, we're looking at charts, and we're summarizing and aggregating the data. We're trying to draw some conclusions, but we have to keep in mind that to a certain extent, some of the numbers can be out of whack, some of the presentation of the data, because in a certain year, you had a very large default or a very large declaration of bankruptcy in terms of the total aggregate amount. So let's just keep that in mind as we look at data from year to year. Now, a lot of these numbers are corporate related. If we included financial institutions, they would also include Lehman Brothers of 2008, which actually happened to be a single A rated name when it filed for bankruptcy in September of 2008, which turned out to be one of the largest bankruptcies in history. So in terms of that default, and in that in terms of that default, that could distort some of the statistics as it relates to single A names defaulting in that particular year. But we can still look at the data and trends. And you can see here, now I'm going from 2014 up to 2019. I'm looking at S&P data, and I'm noticing again, like what I expect to see, investment grade names tend to perform well, as we would expect. And in non-investment grade names, there's some fluctuation in terms of default rates. Let's also keep in mind, investment grade names doesn't mean that they are susceptible. They're not susceptible to risk. And it doesn't mean that they're not necessarily performing up to par. It's just that there's still ongoing institutions that can meet principal and interest payments. there could be deterioration. An investment grade name can go from triple B to double B or single B and become non-investment grade, but it hasn't defaulted. It hasn't defaulted yet. And that goes back to when we come back and revisit that, the concept of credit deterioration versus credit default. Credit default. This is a little bit more specific. No, so I'm looking at some of the non-investment grade names, and now I'm focusing on the non-investment grade names, but I'm focusing on the rating per se. And so I'm looking at trends, and I would expect, as you see here, the default rates for the triple C's to be much higher than the single B's, and then a little bit higher than the double B's. I would expect this is where I'm going to have my default rates. And again, this shows the prominence and usefulness of coming up and deriving a rating. We derived the rating, and guess what happened? What we expected to happen did happen, that the large number of defaults, the real cluster of defaults, really occur with the triple C to double C to single C names. Now, as I had said, this is the type of data that we kind of use this very carefully. We're going to use this very carefully. You see, from year to year, there are fluctuations in default frequencies. There is fluctuation. And then I could take an average, I can take a weighted average, and then use that default frequency to determine what should be the default probability of a double B or a single B. What should be the default probability? So there's a lot more art and science beyond just taking the data and then using that as a default probability. And as I said, let's keep in mind that sometimes some of the trends could be distorted because there can be cases where a single A name, as we saw in the financial institution world, the Lehman Brothers, can file for bankruptcy, or a double B name can file for bankruptcy, as you see here. What I also want to remind ourselves is to say that what we don't do is rate a name and then rate a name because, or as part of the analysis. We don't, in the analysis, as we're looking at earnings and cash flow and balance sheets, working capital and capital structure and debt levels, we don't come up with a probability default and then map that into a rating. This is our reminder once more. We do the analysis and come up with a rating and then map that into a probability of default. At least that's the conventional way of how we approach this. Now we get to 2020 and 2021. So as we know, there are lots of bankruptcies and default situations throughout the year because of the pandemic, because of global recession, and also related to industry. So this shows you the importance of not just looking at it by rating, but also looking at certain industries. Without a doubt, some industries that were thriving and doing fine before 2020, the airline industry, for example, of course, actually plummeted and sort of imploded in 2020 because of the pandemic. So we can make observations about certain industries and look at default rates by industry as it relates to 2020. So you see here, airlines, retail, automotive, entertainment, oil and gas, travel and hospitality. These are all industries that were vulnerable throughout. So if I were to look at default trends, I will expect to see a large number of troubled and non-performing names in those respective industries throughout the year. And of course, default rates and bankruptcies did increase. And as you see, well, as you'll see on an ensuing page, you'll see how they're tied and mapped to these particular industries. Were there predictable signs at the outset as it relates to these industries in 2020? Yes, there were. Were there signs in 2019? No, because we didn't know the pandemic was going to come. And so as we're looking at these names kind of going forward, we're kind of looking and say, are there vulnerable names, borrowers, corporate counterparties
in these industries for which we're going to have to change our rating and increase the probability of default. Now, some of the names actually are in bankruptcy, but some of them have actually deteriorated, but still are ongoing enterprises. On the other hand, what we'll do is that as we start watching 2020 and is now into 2021, this is not over yet. What we also do is try to figure out, why is it that some companies have been able to thrive more than others? Part of risk management, part of analysis. Some companies in vulnerable industries have been able to thrive while others were not able to do so. Here's just sort of a sample of US companies that filed for bankruptcy in 2020. And then you can see the industries that which they're mapped into. You can see a lot of vulnerability in some of the consumer products and retail industry. Retail, JC Penney, J. Crew, Models, Pier 1, Goes Gym. In terms of global, we can see airlines have had issues, LATAM Airlines, Avianca Airlines as well. As we know from 2020, oil prices actually nosedived, especially in the mid portion of 2020, and this put this made energy and oil and gas companies quite vulnerable during this period. So this is just a sampling of some of the bankruptcies. But as we look at this, as I say, we're also trying to look at this in terms of risk management. Why is it that some companies in these same industries were able to thrive? What is it about them intrinsically? Cash on the balance sheet, not as much debt, a lower debt burden, shrewd management, expanding into other industries, reinventing themselves. Why is it that some companies were able to avoid default? They did deteriorate, but they were able to avoid default and then actual bankruptcy. And so that's sort of our approach now as we observe what's been going on in 20 and in 21. As we would expect, the pandemic has had a big impact in terms of default rates. But by the time we got to the middle of the pandemic in mid-year 2020, there were reports that over 100 companies around the globe with at least $50 million had filed for bankruptcy. This is by July of 2020. Companies with over 50 million in debt had filed for bankruptcy. As we mentioned also, some bankrupt names were victims of the pandemic without a doubt. That relates to many of the airlines. Some, their business models were based on, based on social contact and constant interaction among humans. They were expected to be victims. There were some other companies, there were companies that were vulnerable all along. It's just that the pandemic sort of pushed them off the cliff. And that had a lot to do with a lot of retail-oriented companies, retail department stores. And so many of those companies were sort of barely hanging along, and then it sort of put them over the hump, and it sort of fell off the cliff as a result of the pandemic. Other companies have a substantial amount of credit obligations, a substantial amount of debt. Many companies operate with a substantial debt to equity ratio, or what we also call the debt to EBITDA ratio. They have capital structures where there's so much debt. And some of those companies could have survived if they did not have an excess burden of debt on the balance sheet. I might argue that could be some of the rental car companies. You see that Hertz filed for bankruptcy during the course of the year, but it was a company that was just overloaded. Yes, the rental car industry imploded, but at the same time, it was also a factor of this excessive amount of debt on its balance sheet. So when I go back and look at that, I do try to figure out industries. Why is it that some companies thrived in the industry? How is it some companies that are in vulnerable industries were able to kind of hang on? And then what is it about the companies that had too much debt on the balance sheet? So now by the time we get to early 2021, we can now see the default rates. And so default rates are kind of running at about that 10%. Remember, we had seen that between 2015 and 2019, default rates for names BB, BBB, and investment grade, they were running less than 5%. They were running less than 5%. Now you're seeing that as a result of the pandemic, as expected, we're seeing default rates as based on the reports from the rating agencies of anywhere from say 10 to 15%. So default rates increase as we would expect, certainly increase as we would expect. So the takeaway in terms of credit markets is that default trends are such that there are peaks and valleys, there are clusters, and then there's also correlation. In module 3, we'll go back and look at correlation. Correlation says that for certain names in the industry, if there's a default probability, what is the default probability that the companies in clusters will default at the same time? If we look at this independently, company A has a default probability, company B has a default probability, but not the default, the probability that they'll default at the same time is not the same as their respective probabilities. So what we're trying to see is that, well, what's the probability that they'll both default? That's our worst case scenario, is that when clusters, large numbers of companies that appear to be independent, they sort of default at the same time. They may appear to be independent, but they're affected by some of the same environmental or economic factors. Credit deterioration, and this is something we're going to also revisit in module 3. This is the path to default. What happens to a company's credit rating over time? What happens to a company's credit rating over time? And then what is the probability that it will deteriorate from year to year? Not the probability of default, but the probability of deterioration. So in my example here, I have a name that is a very high investment grade name on my spectrum of AAA to D. And then over time, there could be deterioration. It could deteriorate. So there's a path to default, not necessarily a jump to default. There's a path to default. And so we want to say, what's the probability if a name is a single A that it will deteriorate? It will be downgraded by 1 notch, 2 notches, 3 notches. What's the probability that it will be upgraded? Some companies actually get better, not the probability of default, but the deterioration. And so many risk managers prefer to look at this as much as default, because companies get worse from period of time. They don't start off AAA and they jump to default. They tend to gradually disappear and then finally become triple C or double C rated. You see the default frequencies for those names that are C in the C category tend to be about 25% high. When they're in the single A area, the default rates are much less than say 3 or 4%. So credit deterioration, we're trying to make that distinction between credit deterioration and credit default. So analysts often analyze markets and they try to determine the probability of default, but they also try to determine the deterioration and performance from year to year. We call it credit deterioration. It's also called migration or transition. What's the probability that a name that is single A, not default, but it'll go from single A to triple B minus? What's the probability a single name will slip from A to A minus, A to triple B plus, A to triple B, to A to triple B minus? It's still an investment grade name, but we want to look for signs of deterioration over that period. And as I say, we can call it migration, transition, deterioration. Sometimes it's called the time to default or the path to default. And as in sum, the importance there is that a AAA name is not likely to default as much as a AAA name, it was more likely to deteriorate. If a name deteriorates, it can deteriorate. It reaches the point of non-investment grade where the default rates are going to be much, much higher, as we've seen from the default frequency data. So that ends lesson 1. Let's just do the takeaways right quick from lesson 1. We looked at current topics and trends. We looked at some of the environmental and economic operating environmental factors that included that have impact on default rates. We talked about and summarized what's been going on in 2020 in terms of default rates. We identified some of the industries that have been vulnerable, and then we tried to sort of introduce insight about how we can kind of classify the phenomenon of 2020. Companies in vulnerable industries, companies in less vulnerable industries, companies that actually thrive, companies that didn't thrive, companies that were prepared, that were in vulnerable interests, but were prepared to be able to kind of get through 2020 as well. And then companies that had high debt structures, no matter what industry they're in, that may put themselves in a pretty vulnerable situation. And then we also taught the lesson talking about credit deterioration versus credit default. And then how do we define and identify deterioration? We will revisit credit deterioration in module 3. Lesson 2, now we're going to look at market indicators and credit models. How can that be useful to us as we assess credit risk and we try to get some sense of some of the perceptions by others who are involved in credit markets and in the industry? So number 1, lesson 2, market indicators and market metrics. They also assess credit sometimes in very different ways, using different types of metrics. They also try to derive probabilities of default. So we'll take a peek at how can we infer a probability of default based on the metrics and phenomena that they follow. We'll look at some of these metrics: credit spreads, bond prices, equity prices, look at trends. And as I said, what we're trying to do is discern credit risk from market metrics. And then we'll end this lesson looking at some of the credit models. They're independent companies, independent models that use data, statistics, and observations. And based on those data and statistics and observations, within a model, try to derive a probability of default, and then we can map that into a particular rating as well. It does not necessarily involve the deep or in-depth type of analysis that I've been talking about at the outset of this course. It doesn't involve necessarily looking at earnings and cash flows and balance sheet and management and all the different categories. It's looking at technical data and technical trends, and then based on that data, as I said, to be able to sort of infer a probability of default. So we'll take a peek and summarize those types of models that are actually done. They can be useful, and they have, some of the models have been very, very useful predictors of defaults over the last couple of decades. So when we talk about market indicators, can markets and financial instruments be used to predict defaults and quantify default probability? And we're looking at across the spectrum. We're talking about credit and equity markets. And so there is data, bond prices, credit default swap prices, stock prices, other types of models. And so, and they can fluctuate because these are markets. These spreads, these prices can fluctuate from day to day. Ratings from the credit rating agencies do not change frequently. The market metrics, bond prices, CDS spreads can change from day to day. Equities, especially the stock market. Stock market reflects sentiments every single hour of a particular company. And so there's some market indicators and some models that use stock prices to try to predict probability of default and then map that into a particular credit rating. And so can that be useful to us? So the goal here is not necessarily to buy Tesla stock or Merck pharmaceutical stock in anticipation of increasing the value of the stock based on growth in revenues. The goal here is to sort of to get some sense of, is the market trying to tell us something about the company that could increase the probability that it can't make the payout on its debt and liability obligations. So we're trying to kind of get some sense of what is it that they perceive? How are they interpreting the business and operating risks of the company that could have impact on the changing probability of default? Probability of default, as I say, probability of default. Rating agencies, let's just say, remind us of, they don't fluctuate. Markets change based on new information and new interpretations of that information every single day. So it can, as I say, it can be useful. We have, as I said, bond spreads. We have models. And so we don't have time to go through each of the type of models. Some of the models you see here are summarized by a model called KMV, a model called credit sites, bond score, credit grades, credit risk model. These are actually proprietary models that take market-related data or public data and then try to translate that into a probability of default. To the extent that we have access to the model or have access to updated market data, then how can it be actually helpful? So the information is there. Now I want to try to kind of understand how it can be useful, and then remind ourselves it is not a substitute for our own analysis and assessment of risk. What I've been saying in the previous lessons or in the previous module is that what I want to say is that understanding how are these models and these markets interpreting more conservatively? Do they have a little bit more access to information or insight or expertise about something as it relates to a particular company and is reflected a little bit better in their assessment of the probability of default? And then is there sort of different angle or approach that they're taking when they're analyzing a company, or different look in terms of a company's revenues, cash flows, or its competitions, its markets, or its particular products? So market indicators and credit models, they take information, they take reports, and they take also understanding of the particular markets. And then the spill out from that is that what we can do, whether the models themselves do it or we can do it ourselves, what we're trying to do is derive their perception of what the probability of default of the company is. If we have been using Tesla, credit spreads in Tesla debt, credit spreads and the credit derivatives of debt for Tesla, that changes from period to period. If it goes up, if the credit spread goes up, remember credit spread is equal to the expected loss, which equals the default probability times the loss given default. If it goes up, that means that the market is perceiving that its default probability has increased. So I'm going to take that credit spread I see in the marketplace, and then I'm going to try to infer. I'm going to try to figure out what does the market think that the probability of default is of Tesla today versus last week versus 2 months ago. Other models that you see here, credit sites, bond score, credit grades, credit KMV, will also use similar information, other data, other statistics, and then they will tell you based on certain trends, certain volatility in the equity market, certain assets on the balance sheet, certain other types of data, and then they have to spill out the outcome of the model. It says, this is what we think that is the probability of default for this particular obligor or company on this particular date. And so it's, and I'll repeat, it does not substitute, but it does give me some sense of that others might be interpreting my credit exposure differently than what I'm actually doing. Now, let's get back to basics. Market indicators from credit spreads. So credit spreads, I can derive those from bond prices, from bond yields, from the credit default swap market. I can take those credit spreads and then try to translate that into default probability. This is a very simplistic approach. A bond price has a yield to maturity. If I take the risk-free rate plus the credit spread, that's going to equal to the yield to the maturity. And then from that real risk-free rate, I can derive the credit spread, for that particular bond that's priced as of today. For the CDS market, that's the derivatives market, I can actually take the credit spread that's quoted in the CDS market. And then what I will do is I understand that the credit spread is equal to the probability of default times the loss given default. And then my implied probability of default is going to equal to the credit spread divided by the LGD. Now, what we're going to do is that we're going to make an assumption that this is unsecured senior exposure. That's fair. So a lot of these spreads, whether it's bond, that's unsecured senior exposure. The CDS is also going to be unsecured senior exposure. The CDS market will also define a tenor. So I'm going to look at this in terms of tenor as well. The CDS market could be 1 year, 5 years, 3 years, 10 years. The bond market, of course, is going to be based on the tenor of the bond. It could be 3, 5, 10-year bonds. So remember, this tenor is important too, because the probability of default is a function of the credit rating, the credit analysis, the credit worthiness of the obligor, but it's also a function of the tenor as well. So I've got my formula, right? This is a very simplistic approach to it. And then I take the spread that's quoted in the marketplace and I divide that by 0.4, because I'm assuming that my loss given default is going to be 40%. I'm assuming that if the company goes into bankruptcy, if I'm senior and unsecured, then my recovery rate is going to be 60%. My loss is going to be 40%. There's a lot of data and a lot of history that sort of suggests that that is not unusual. That's not unreasonable. So let's assume that the LGD is 40%. And so then I take the credit spread, I divide that by 0.4. Now I have my probability of default. And so I compare that probability of default with my probability of default that I derived from doing an analysis. If I do that, that means that if I do that, the market might say that the probability of default over 5 years for Tesla is 3%. And I might say the probability of default is 2%. So I might wonder, what is the market seeing that I am not seeing? I don't necessarily change my analysis. I'm just going to try to investigate to what extent that they're seeing that I'm not seeing. They may not have the market may not project Tesla's performance and cash flows as high as I am projecting, or the market may say that there is the impact of competition on Tesla, which could have impact on its ability to be able to pay down its $9 billion in debt. So it doesn't substitute the analysis, it supplements the analysis that we do. So that's how I can use the markets to kind of come up with an implied probability of default to supplement my analysis. Then I have, then I can also use the equity markets. So there's something what we call a structural model. This is popularly done by what is called the KMV model. It's also called a structural model. It's also called the Merton model. Merton is named for Robert Merton, who is an economist and Nobel winner. And so in that particular model, what it does, it tries to translate equity prices, stock prices for the company. It will take the stock price of Tesla, PepsiCo, Merck, any of the companies that we've been talking about in terms of cases today, and then translate that into an implied probability of default. That model is based on the volatility in equity markets. And so what that model is saying is that the more volatile the equity price is, the more volatile equity prices are, the more volatile the assets are on the balance sheet, greater volatility as reflected by standard deviation and variance of equity prices implies higher probability of default. Now, we don't have time to go into the details of that particular model, but it says that I'm going to take equity prices. I'm going to take stock prices of a particular company like a Tesla or a Merck. I'm going to measure the volatility of that stock price. And I'm going to use that measurement of volatility and translate that into my notion that more volatility increases the likelihood that the company will not be able to meet its obligations, or it'll have a higher probability of default. And I'll map that into a particular credit rating. So that's the KMV type of model. So I can use bond spreads, I can use CDS spreads, and then I can adapt to the KMV model. And again, supplementing my analysis, not substituting for my analysis. Now, these models have been around, or these approaches have been around a long time. We could also go back and look at, has there been a success rate? Was KMV very good in terms of predicting the default and demise of certain companies? Did the CDS market more quickly project the demise of certain companies and certain bankruptcies? Do bond spreads reflect higher default probability than, say, credit ratings actually do? And you can notice that over the last 20, 25 years, some of these models and some of the reflections of negative sentiment as reflected by spreads have been very good predictors of higher default rates or bankruptcy. So we don't dismiss the models. As I say, even though the models don't necessarily, or the markets don't actually do the analysis in great detail, they sort of fluctuate from day to day, but they have been reasonable and very good predictors of the demise or bankruptcy or defaults of certain prominent borrowers. So we can take a peek. Now, when we talk about models, when we're talking about markets, bond markets, CDS markets, and equity markets, talk about models. These are computer models, algorithms. They take data, a number of different types of data. They put it into a black box and it outspills a probability of default. So there are many types of credit models that are out there. And these are sort of the general categories of those types of models. They can be talk about top-down models, bottom-up models. What that means is that they're taking macroeconomic data and then trying to translate that to the impact that macroeconomic data, GDP, inflation, unemployment, interest rates, the extent to which that can have impact on a particular company and its probability of meeting obligations, or a bottom-up model where we actually look at each company on a case-by-case basis. There's also something called credit VAR. We're going to revisit credit VAR that's related to credit deterioration, and we'll look at that in module 3. There are also what we call structural models. That's the KMV model. So that's looking at assets and liabilities on the balance sheet and looking at volatility of assets on the balance sheet and sort of measuring the volatility of those assets on the balance sheet and tying that to equity volatility. If the stock market, the share price of a company is volatile and fluctuates, then we'll make the assumption, and I'm simplifying this for this course purposes, is that the assumption is that the assets prices, the values of the assets on the balance sheet are volatile. More volatility, the less likelihood that it can meet its obligations on an ongoing basis. Then we can have what we call the intensity or reduced form. That's looking at what we had talked about, the credit default spot spreads and the bond spreads. So there are different types of models and we can put them in these classifications and they can be useful. They can be useful. And as I said, my goal is not necessarily substitute, it's a supplement, but my goal is also to try to understand, are there certain factors that these models are incorporating that I am not incorporating? Are they looking at certain things that I am not looking at? And so how can I interpret that and understand that better? Now, credit spreads. One interesting thing is that In theory, credit spread for a company should be the same, whether it's in the loan market, the bond market, or the CDS market. But credit spreads could change depending on the type of market that we have. So if we're talking about Tesla or Merck or PepsiCo or Apple or Microsoft or whatever, credit spreads in theory should be consistent from market to market. There's a credit spread in the bond market, there's a credit spread in the loan market, there's a credit spread in the credit derivatives market. And so do credit markets reflect consistency in spreads? And if there's no consistency, why is it that one marketplace may have a different credit spread than another marketplace? So there are a number of factors that could go into it. Those who are involved in trading, they would note that if the credit spread differs for hedge funds, there could be sort of an arbitrage opportunity. So for example, if my credit default swap spread is greater than the bond spread, where in theory they should be the same. In theory, if the credit spread in the credit derivatives market is 350 basis points, in the bond market is 325 basis points, it should be the same. Then there could be an arbitrage. This is where the hedge funds can step in, and in that case, to affect the arbitrage, they would sell a bond short, sell the CDS. We won't go into the details, but what they're doing is they're trying to take advantage of different markets. They're looking at the same company and the same risk, but they're pricing that risk differently. And as a result, let's, as a hedge fund, putting the hedge fund cap on for a second and say, how can I take advantage of that and introduce a profit opportunity as a result of that type of discrepancy as well. So just like any other thing, different markets are also looking at the same risk, but they could have a different assessment. I could have a probability of default from my analysis. The rating agency could have an implied probability of default from its analysis. The bond market can also have a credit probability of default from its perceptions. And then the credit derivative market can also have a different perception of that particular name. So there are different perspectives of credit risk in different marketplaces and in different segments, could also lead to the indication of different spreads. So that winds up the lesson 2. And so as we kind of look at in terms of takeaways, there are market metrics and market indicators that assess credit risk. They don't substitute for the analysis, they supplement the analysis. And what we're trying to do is interpret and understand what insight, what piece of information, what extra expertise they may have in understanding the credit risk of that particular company. And then we also have different models. These are independent companies, independent models that use algorithms, computers, data, and then come up with a probability of default, an implied default probability. And they can be useful too. The takeaway here is that they may not involve the intricate financial analysis of balance sheet, earnings, operating cash flow, working capital, and capital structure, but they have actually been very good predictors in the past in projecting certain credit deterioration and defaults and bankruptcies in certain companies in the past. This is the beginning of module 3. In module 3, we're going to focus on credit portfolio management. So we have spent module 1 and 2 for the most part looking at single names, single loans, one loan, one obligor, one borrower, one counterparty. Now we're going to step back and look at in terms of a portfolio of exposures and portfolio of names. In lesson 1, we look at some basic portfolio concepts, essential concepts in managing portfolio risks. That includes correlation and concentration, unexpected loss, and expected loss of the entire portfolio. We'll kind of take a peek a little bit more in depth about how the concept of unexpected loss is what bank regulators look at in determining a capital requirement for a bank for the credit risk in the portfolio. And then we'll talk about credit value at risk. Remember, this is credit deterioration. And then we can now come up with a value, a metric, and very similar to a market value at risk. For those of you who are familiar with market value at risk, what we try to measure there is that within a certain confidence level, within a certain probability, what is the most that we can lose in the value of a market portfolio of trading assets? We try to translate that into the world of credit. In the world of credit, we say, because of credit deterioration, what can we lose the most within a certain confidence in terms of the market value of trading of credit assets, whether they're loans or bonds? What is the most we can lose? Not default, but as a result of deterioration, credit spreads increases. When credit spreads increases, then bond prices go down. What is the most that we lose? So that's the concept of credit value, and we'll go back and sort of look at that a little bit more in depth. Credit portfolio management. So here's a balance sheet. This is not the balance sheet. This is not the balance sheet of a company. This is the balance sheet of a financial institution. And so in that financial institution, it could be an insurance company, it could be a bank, it could be a fund. It has a portfolio of credit exposures, loans, bonds, commitments, counterparty trading exposures. So how does it manage that exposure, that collection, that aggregation of exposures on an ongoing basis? It can calculate expected loss for the entire portfolio, and then it also can calculate unexpected loss. And then for a bank, as we had mentioned, the expected loss is going to help us determine a credit provision, a loan loss reserve. On average, how much is the bank going to lose as a result of credit risk in each year? The average, the unexpected loss is going to be what's the worst that it could lose with a certain probability. What's the worst that it could lose in a certain probability because of credit risk? Here, this is at on average. Let's think of that as on average, what it could lose per year. And then what we're going to do is going to take a charge to earnings. So we're going to predict on average what our losses could be in the portfolio. And then we're going to take a charge to earnings. And that's my loan loss allowance and my credit provisions that we see on bank accounting statements. The unexpected loss is that when I look at that portfolio, I look at the worst case scenario. And so in theory, it's with 99% probability. What's the worst I could lose in this portfolio? And that's, I'm going to have capital. I need capital to absorb that loss. So if I have a loan portfolio of $1 billion, and if I say the worst case scenario is unexpected loss, not the average loss, is that it's going to be $100 million loss, then bank regulators will say you need $100 million to absorb that once in a 99 year event, once in a 100-year type of event, a catastrophic type of loss. So this is what regulators want to see in terms of the credit risk and how do we sort of absorb that once in Armageddon situation type of loss on that balance sheet. And so portfolio risk is our next step beyond looking at each name, each exposure, expected loss, probability of default, ratings. Now I step back and look at the entire portfolio. So the purpose of portfolio management, we want to look at the expected loss of the entire portfolio by all products and categories of risk, including not just loan outstanding, but commitments, revolving credit commitments, letters of credit, counterparty trading exposures as well. And then we're going to try to use that benchmark for expected loss to calculate my loan loss allowances. And then we're going to need to use that as a basis to go one step further and calculate the unexpected loss in the portfolio as well. Keep in mind, expected loss is a function of probability of default. Expected loss is also a function of tenor. It's a function of whether we're 1 year out, 5 years out, or 10 years, as much as it is a function of the rating itself, is a rating. Here is a hypothetical example. This is a hypothetical example. I have a portfolio. I have 8 loans in the portfolio. And so for the 8 loans in the portfolio, in the first column is the outstanding. This is the outstanding. So these are loan outstandings. This is the outstandings. This is in millions. And I have 1.1 billion total outstandings. The second column, credit analysts would have done an analysis of the company, of the loan. And so regardless of whether it's secured or unsecured, at that point in time, it's really about coming up with a rating. Credit analysts will come up with that rating, and then we'll map that into a probability of default. All right, again, this is hypothetical. We now have our PD. Then for each loan, I'll look at the type of support, collateral, guarantor. I can look at whether it's senior or junior, and I can calculate my LGD. The lower the LGD, the more likely that the loan has been collateralized. The higher the LGD, the more likely that the loan could be subordinated. So in this example, if the LGD is 5%, that's going to mean that it's a collateralized loan. The LGD at 75% is going to suggest that the loan is subordinated. The LGD at 35% is going to suggest to me that the loan is senior and unsecured. This is hypothetical. So we come up with the LGD, and then for each loan, I'm going to calculate the expected loss. Very simple. Probability of default times the loss given default times the outstanding. I have my expected loss for each loan. I sum that up. And so for my hypothetical portfolio of 1.125 billion, I now have an expected loss of 5.3 million. That's how much I expect to lose in that portfolio. And I hope to compensate for that by having a net interest earned, a LIBOR plus credit spread that's going to exceed 5 million. I want to make sure that when I price these loans, in each case, that my earnings, my credit spread is going to be higher than 5 million. Or more specifically, my credit spread is going to be higher than 47 basis points. So this is a hypothetical example. It's a very, very typical example of how a portfolio is measured. And then from period to period, companies evolve, deteriorate, get better. We will change the default probability. From period to period. As an aside, I'll say this very quickly. Many banks in the first quarter of 2020, they increased their loan loss reserves mostly because default rates increase. So therefore the expected loss will increase, and so we would increase our loan loss reserve. Now, they also increased for other factors, but it had to be a very, very important factors as we're going into the pandemic in the first quarter of March 2020. By the time we get to the fourth quarter and we see some recovery in the economy, we see some resumption of economic activity, then the default probabilities have come down, the expected losses come down, and then banks actually can reduce their loan loss reserves. So this is done on an ongoing basis. We don't do it once a year, occasionally. On an ongoing basis, we're sort of looking at the rating of each of these loans after having done the analysis, and then map that into a default probability, and then map that into, and then actually do the calculations for expected loss. What we don't have here, and this is where it gets complicated. What we don't have here is now, we haven't looked at correlations, and we haven't looked at unexpected loss. we haven't looked at, and we got to make sure that did we look at these default probabilities based on tenor and not just on credit ratings as well? Did we look at the unexpected loss? And then we take into consideration correlation and concentration. And that's where it gets a little bit more complicated when we start talking about how do we analyze these different types of portfolio risks. So portfolio management includes looking at the portfolio. So this balance sheet, again, it is not the corporate, it is the financial institution that is involved with having credit risk on its balance sheet, lenders, investors, investments in bond portfolios and loan portfolios, loan commitments. And so here's my checklist. If I'm looking at a portfolio, I want to make sure I'm looking at overall default and recovery risk. I need to look at concentration. I need to look at correlation. I also need to look at incremental and marginal risk. And what that means is that to what extent my next loan is going to have impact on the overall portfolio. How is it going to change the concentrations and correlation? I have a loan portfolio that's 500 million. And if I add another loan, how is it going to change the look of the portfolio? Is it going to make it more risky? It's going to make it less risky. It's going to make it more concentrated. It's going to make it less concentrated. Pricing risks, of course, that goes back to what we've been talking about all along. Got to make sure that we're compensated for the expected loss in the portfolio. And so this is out of the scope of the course. What financial institutions also have to make is how are we going to fund that loan portfolio? And that's related to liquidity risk. That's not in the agenda here, but financial institutions are very sensitive about, I've got a loan portfolio, I'd have to fund it. How do I fund it? How do I make sure that I have the funding in place to be able to support that? And then the last thing here is that what is the capital requirement? So whether an insurance company or a bank or a broker dealer or whatever, I need a certain amount of capital to absorb not the average loss, not the expected loss, but the unexpected loss, the worst case scenario, that once in 100-year event that could be so imploding. What is that? How much can we lose? And could the bank survive that worst case scenario? That's what we call the capital requirement. So let's go back and talk about this unexpected loss. So we have expected loss, but then have unexpected loss. And the unexpected loss accounts for losses beyond the expected. And it's really related to historical volatility in the default probability or default frequency. So very simplistic presentation of this is that for a loan, I have come up with a rating. I now have a probability default. And so based on that probability default, that was an average. Remember, we looked at our default frequencies, and that was an average over 40 years. But in some years, the probability default can be much higher, and some years it could be lower. Over that 44-year period we looked at in the Moody's example, that was an average. Then some years, if it's a 1-year loan, 5-year loan, the probability of default was default frequency was much higher. So what I need to do now is look at what is the variance in probability of default in each year for each type of loan, for each rating. So if on average, if it's a single B, and if on average the probability of default or the default frequency was 0.5%, well, in some years it could have gone to 2%, some years it had gone down to 0%. So what's the variance in terms of that probability default? And so I'm paying attention at the peak. How high did that default frequency go for certain ratings? How high? And I'm going to use that as a basis of calculating my unexpected loss. Now, I'm presenting this in very simplistic fashion. What we're trying to do here is just understand the concept of default probability in terms of the average default probability, default frequency, and then what's the worst? How high can it go? A single A name on average might default 0.5% of the time, but in some years it might go to 3%. Some years it might go down to 0%. So how high can it go? And that's what I want to do when I count for unexpected loss. Basel III, which is bank regulation, guidance for banks around the world, Basel III says that unexpected loss is a result of a calculation. And so what Basel III says, what is the worst that you can lose in that loan portfolio or in your credit exposure with 99.9% confidence? For statisticians, what that would mean is that what Basel says is that let's assume that the distribution of losses as it relates to probability of default is a normal distribution. That's an assumption. And then what we're going to do is that we're going to look at that in terms of a normal distribution. So based on that probability of default, how high can it go and then how low it can go? I'm worried about the high. How high can that probability of default go with 99.9% for that particular rating? If I'm looking at a single A name, I see the average is 0.5%, but with 99.99% probability, how high can that probability of default for a single A name go? And then we're going to multiply that by the LGD, and then that's going to determine what my unexpected loss would be. For the most part, for a name and for a portfolio, our losses are going to be right around the expected loss. But Basel says, I'm not worried about the expected loss. I want to look at the worst case scenario. And then do you have enough capital to support that? Do you have enough capital to support that amount of loss in a single year? That's the capital requirement. And it goes back to the portfolio, the unexpected loss on a name by name basis. And then in aggregate, the unexpected loss for the entire portfolio. There is something that does go into the consideration, correlation in terms of default probabilities. Remember, we talk about two names, A and B, can both have a default probability. And then, but if they're very highly correlated, then if one name goes into default, then another name can go into default. If one name goes into default, another name can go to default if there's a high correlation. So Basel III requires that banks, when they do their calculation of this concept of unexpected loss, that they must take correlation into consideration. That's very complex. It's a little bit out of the scope of this particular course, but it does say that you've got to take correlation into consideration. If obligors and names are highly correlated, then our default probabilities are understated. Our default probabilities could be understated in terms of looking at a name from name to name. So we now go into other aspects of portfolio risk, concentration risk, and then we're going to return to correlation risk. Concentration risk is what it is. It's measured based on individual loans or groupings of loans by industries, currencies, or geographies. And so I want to know, in my loan portfolio, how much of it is concentrated in airlines? How much of it is concentrated in oil and gas? How much of it is concentrated in consumer and retail product companies? And so I try to measure concentration. We know that too much concentration in a vulnerable industry is not a good thing. Concentration leads to high correlation as well. And so are there ways for us to measure concentration? Many banks will look at this, or many portfolio managers, and they'll say anything that's more than 10% in an industry, anything that's more than 10% for a particular country might be too excessively concentrated. So different banks and different portfolio and risk managers may have different ideas about what constitutes concentration. I'm using a benchmark, say, I've got a portfolio of corporate names and borrowers and credit exposures. Any one industry that's above 10% could be my benchmark of what I would call excess concentration. Excess concentration. We could also use what is called the Herfindahl-Hirschman index. I introduced that as a tool, HHI index. It is an index between 0 and 100%. And we can do this calculation. If there is a loan, there's only one loan in the portfolio, then the HHI index is 100%. If there are 100 loans in the portfolio, and if each one has 1% of the total exposure, then the HHI index would equal to 1%. So the higher the HHI index, the more heavily concentrated the loan. So we can use that index to sort of measure to what extent is the portfolio becoming more concentrated from year to year. In the example above, I have 7 loans. I have 7 loans in the portfolio, and I want to measure concentration. So the HHI index, based on the HHI formula, would say that it's 21% HHI index. What I would do is I'll measure that against other firms, other banks, other portfolios, or I'll measure that in terms of trends from period to period. Now, I can eyeball this, right? Eyeball this, I see 15%, 10%, 11%, 12%, 37%, anything that's above 10%. But I also can use a metric. So as I measure concentration from period to period, it is called a Herfindahl-Hirschman index. It is one way of being able to assess concentration, whether it's increasing or decreasing from period to period. So correlation risk. Concentration can lead to correlation risk. Correlation is looking at the loans in the portfolio and determining whether they will default at the same time. It could be loans in different industries, different geographies, and different countries. And so they could be seemingly very independent loans. What is the probability that all the loans or large groups of loans will default at once? So this is a very simplistic portfolio. More complicated portfolios would include sort of a bank loan portfolio. It could be loans that are in certain countries, loans that are in certain states, or in certain industries. So what's the probability that they're both one group of loans, one set of loans, will all default at the same time? What's the probability that we'll have clusters of default? And so how does that correlation have impact, not only in the probability that large groups of loans default all at once, but also in terms of calculating unexpected loss in the portfolio? So the more highly correlated that the loans are in the portfolio, then therefore the higher the losses or the unexpected worst case losses that we would expect to see in the portfolio. There are different ways of approaching this. I think the most important is to identify and understanding what is correlation risk. We more specifically call it default correlation. How do these loans sort of in terms of how are they interrelated? How are they related? And so are there factors that influence one set of loans and also influence a second set, which will contribute to large clusters that default at the same time? So once we understand what we're trying to get at, then we try to quantify that. Now we can look at that in terms of if loans in the same industry are more highly to be have default correlations that are high. Loans that might be subject or influenced by the same factors. Two companies, two sets of loans that are in two different industries may be influenced or may be susceptible to some of the same factors as well. So we could consider that there are a lot of situations last year that companies in very different airlines, travel and hospitality, entertainment industries, they're very different loans, different companies, but they're all susceptible to some of the same factors, which could contribute to clusters of default. So portfolio managers understand what correlation is. Sometimes they struggle with how to actually quantify it. Now, we're not going to spend that much time in this particular course of trying to go through some of the history of how risk managers have tried to quantify and address it. There is the Basel III, as it relates to bank regulation. Basel III has an approach as well. As I had mentioned, that to calculate the capital requirement for a loan portfolio, it calculates unexpected loss, and then it adjusts that for correlation. It makes a certain assumptions and adjusts it for correlation. So The performance, let's kind of summarize it without going too far in depth, because that's beyond the scope of what we're trying to cover in this session. The performance of individual loans can be correlated. Defaults on certain individual loans can occur at the same time if they are highly correlated. And then if the probability of default can be derived or determined, and if expected loss and unexpected loss are calculated, then how do we adjust those calculations for correlation? So that's the objective here. And so whatever model, assumption, or approach that we use, we're trying to achieve the objective of adjusting for portfolio default correlation. Risk managers try to find the most effective method to address that correlation. Now, one quick example of the impact of correlation. Let's just make a simple example. I have loan 1 and then I have loan 5. And let's assume that we look at them independently. This loan has a probability default of 0.5%. This loan has a probability default of 2.0%. If they are highly correlated, and if therefore the default probabilities are highly correlated, then what's the probability that if they are 100% correlated, then what's the probability that they will default at the same time? What that means here is that they have independent probabilities, 0.5% and 2.0%. If they're 100% correlated, that means that loan 5 defaults, loan 1 is going to correlate no matter what the default probabilities of for loan 1 is. That means that if they're 100% correlated, that means that if loan 5 defaults, loan 1 will default also, which means I might have to adjust this default probability to reflect the same default probability of loan 5. So 0.5% default probability is understated. I might need to adjust it to 2.0% to account for the 100% correlation with loan 5. That gets more complicated because in my portfolio here, I have 7 loans and I have over 40 possible pairings. In a large loan portfolio, I can have millions of possible pairings. So I'm explaining the challenge in dealing with correlation, but at least we try to at least acknowledge it and then try to come up with suitable methodology to at least account for the correlation. I don't want to ignore it. I want to understand what the possible impact could be. In this case here, going back to the same hypothetical portfolio, if performance correlations are known among the pairs of loan assets, can we assume the default correlations are similar with the example that we just used? How should we adjust the model in terms of calculating unexpected loss to account for all the different loan pairs? And then how do we approach default correlations in terms of a distribution tail? You remember in the Basel III computation, it looks at the expected loss, then it looks at a normal distribution around the expected loss. It calculates the unexpected loss based on volatility or variance in probabilities of default. And then also calculate the unexpected loss. So that there's the notion that the more highly correlated or the more impact of correlation on the portfolio, the fatter the distribution in my normal, in my distribution portfolio losses. Correlation will increase. Correlation will increase my unexpected loss. So once we understand those principles, we now have to just say, we have to kind of adjust on what model or what approach we're going to do to account for that. That's beyond the scope of this, but I think it's important to understand, let's not ignore correlation and let's understand the complications that are introduced by correlation as we try to calculate expected loss and unexpected loss in the portfolio. Now let's go back and reintroduce this other concept, value at risk, there is market value at risk, and then there's credit value at risk. We more commonly associate VAR, V-A-R. We more commonly associate that with market risk. And so our basic definition of market VAR would be for a portfolio of securities and derivatives positions in that they're subject to market risk. We want to define what is the worst case loss in market value in those securities and derivatives trading positions over a defined time period based on market factors. Okay, so we have methodology and approaches to calculating that. If I have a portfolio of $100 million in trading positions over a 10-day period with 99% probability, what's the worst that we can lose? And then we go through either computer simulation, historical simulation. We can also calculate variance and volatility, and there's a sort of a standard or common practices in terms of calculating market VAR. What we're trying to do now is transfer that into credit VAR. So now I have a portfolio of investments. Those investments are subject to credit risk, not necessarily market risk. The credit risk can deteriorate and it can have an impact on the market price of the bond. I've already explained that if I have a bond, if the credit risk increases, probability increases, the credit spread increases, that'll have impact on the price of the bond. So to what extent that can credit deterioration have impact on the price of that credit asset? More specifically, in this case, would be the bond. If there's a deterioration, my bond is a single A. If there's a deterioration, it could be downgraded to triple B. And that triple B bond will require a higher credit spread. It's going to have impact on the bond price. What is that value? And so credit VAR takes the same approach as market VAR. What is the worst case loss in value over a defined time period based on deteriorating credit worthiness or decline in the credit rating? And then we can look at different models and different approaches, just like with market VAR, to try to determine what that worst case loss would actually be. So we're kind of transitioning from market VAR to credit VAR. And the way that market risk managers seek to compute a VAR, we'll try to do that for credit VAR. Again, this doesn't substitute for financial analysis and credit analysis. What this does is says, based on historical data, historical transitions and migrations and deteriorations of credit risk, how much can I lose in the value of that asset as a result of that credit deterioration? So we can first, as we do with market VAR, we can set a time limit in terms of over what time period, 1 day, 5 days, 10 days, or 30 days. What is my worst case decline in value? And then a confidence level. To what degree, what probability, what confidence, 95, 97, 99% confidence is my worst case loss. Very similar to how market VAR is calculated in that respect. And then I can look at my distribution of possible losses. I establish a confidence range, and then I can do this calculation of credit VAR, similar to how we do it with market VAR. So whatever the approach is, credit VAR is the maximum loss as a result of credit deterioration. It's not default, it's deterioration. Is actually deterioration. Remember, with default, we're looking at the case where there's a non-payment. Credit deterioration is very likely that the company, the borrower, or the counterparty will continue to make payments. It's just that the probability of default has actually increased. Now, one way we can do this, here's one way we can do it, is looking at what we call a transition matrix. Transition matrix. And what that is that this is information that's provided by the rating agency. Here, in this case, it's Moody's. And Moody's looked at this over a 45-year period. And based on, like we did for default frequencies, this is about ratings movement, ratings migration. And so what happened to a company's credit ratings? What happens to a company's credit rating 1 year later? 1 year later. So my time period is going to be 1 year. And so let's look at the case of a triple B. 85% of the time, a triple B rated company or triple B rated debt, 85% it remained the same. 3.7% of the time, it deteriorated to a double B. 0.69% it deteriorated to a single B. Now, ratings migration, in some cases, the company's rating could improve, not necessarily decline. It could actually improve. So you do see that 4.3% of the time, the ratings for this volume of issues in this particular group of triple Bs, 4.3% of the time, it was improved. The rating got better. It went to single A. What we're doing is that we're looking at risk of loss. And so we're focusing not on improvement, we're looking at deterioration. And so 85% of the time, it remained the same. 3.7%, let's say 4%, it deteriorated to double B. So I could argue just by a snapshot look and say that migration, transition. And so I could say that 89% of the time, a triple B remained the same or deteriorated to double B. I can add what's the probability or the frequency that it deteriorated to single B. Let's call that 1%. So I can say 85% stayed the same, 4% it deteriorated to double B, and then 1% of the time it deteriorated with single B. So this leads me to say that if based on past data, 90% of the time, the worst it got was a single B. That helps me understand in terms of my credit deterioration. So I could draw a conclusion based on the past. 90% of the time, a triple B got no worse than single B. What we're doing is that if we say with 90% confidence, the worst it got was single B, well, the deterioration in the value of the asset from triple B to single B, then what is the price of a single B asset 1 year from now? If I say that 90% of the time it's going to, the worst that could happen based on past statistics is that it'll deteriorate to single B, the price of that bond 1 year from now will have deteriorated because of the ratings decline and the expectation of a higher credit spread. So therefore, I'm going to say, it's going to say my credit VAR is going to be the loss in value of a triple B asset that is now declined or deteriorated to a single B. What is the price of that single B asset 1 year from now? That's how I will implement or use an approach or a model to calculate my credit VAR. And I'm using historical data to determine, just like we would do in market VAR, we use historical data to understand market volatility. Here it's not market volatility, but understand the potential for deterioration and what is the expected rating of that name, the worst expected rating of that name with a certain degree of probability 1 year from now, and what will be the price of that bond based on that rating 1 year from now. So let's summarize that. Credit VAR is yet another tool to assess possible losses in a bond portfolio as a result of not interest rate volatility, not market volatility, but credit deteriorations. So in sum, my ratings migration data, I'm using the Moody's data, can be used to determine that level of confidence of how far the company's issuer rating can deteriorate over that time frame. The time frame we used an example is 1 year. If the rating declines, then the market value of the bond or the loan will decline to account for the higher spread. And then based on prior data and the confidence level that we're going to use, the analysts or whoever the risk manager can determine the greatest migration or lowest bond rating over that period, and then compute the expected price of that bond 1 year from now at that new rating. And that lost in value is going to be referred to as credit VAR. Sometimes they call this unexpected loss in the same way that we call that in the market VAR when you do that particular calculation. And so sometimes it's referred to unexpected loss as it relates to credit VAR. I talked about credit VAR. I talked about unexpected loss as it relates to Basel III bank regulation. That's a different approach. This could also be an approach to calculating a credit VAR or unexpected loss in the portfolio. Different approaches of trying to do this. There is a company, it's called Credit Metrics. And what Credit Metrics will do is that it does calculations of credit VAR using a very similar approach. Now, this is a little bit more complicated in terms of the presentation, but ultimately what it's doing is that's based on a portfolio of credit risks of bonds in the portfolio, credit assets, then it can use data, transition matrices to come up with a credit VAR. So what the credit metrics, it's as a model, it will do the calculations. It will look at the credit rating of the borrower. It will look at the migration tables and statistics that we just described. It'll establish a migration probability. What's the probability that if it's triple B, it'll decline to double B or single B, and establish a confidence level. And then what it will also do, it'll make assumptions about the price of that asset, about or expected price of that asset 1 year from now. So it will do so in a more complicated approach than the simplistic approach. What I'm trying to do is just sort of introduce sort of a generic approach about how we can calculate credit VAR, and then what does it actually mean? What does it actually entail? So this concludes lesson 1, module 3, and our quick takeaways. We introduced the essential concepts of portfolio management, portfolio credit risks. We introduced expected loss, unexpected loss, concentration, and correlation. And we also talked about how Basel III bank regulation in the US is adopted under Dodd-Frank for large banks. What is the objective in terms of capital requirements for credit risk? Unexpected loss, the worst case scenario, 99.9% confidence, which we can lose in that particular portfolio, name by name, and then across for the entire portfolio, and then also account for degrees of correlation. That's going to be the capital requirement. Unexpected loss, worst case scenario, regulators, financial regulators want to see capital as a cushion to absorb that once in a century, sometimes we call it a once in a century type of loss. And then in this section, we concluded with credit VAR. Let's now move to the final lesson. This is lesson 2, module 3. This is where we focus on risk mitigation. And in this lesson, what we're setting out to do is look for methods and techniques for which we can reduce credit risk on a loan by loan case, exposure case, or a portfolio case. We've got loan outstandings, credit risks, credit exposures, commitments, and we have these exposures. Now what we want to do is say, how can I reduce the risk? How can I manage the risk? How can I mitigate the risk? How can I transfer and eliminate the risk? What are some of the popular tools and methods of being able to do so? And we're going to kind of walk through some of this step by step to sort of say, here's my toolbox in which I need to manage risk as we go through a different scenario, a different operating environment, such as what we did in 2020. And then In this lesson, we'll go back and look a little bit more closely at two methods. One would be credit default swaps, which is credit insurance or credit derivatives, and then loan securitization. Two very important and very popular ways for which in a portfolio, we can find a way to reduce or mitigate risk. So the goal here is for the financial institution. It has a portfolio. That portfolio evolves and changes over a period. The prospects for default probabilities and credit deterioration can change given the market, given the operating scenario. Our credit risk strategy, our risk appetite, risk tolerance, risk capacity, and outlook can change over that period. We now have this exposure. We now have this portfolio. What can we do to kind of mitigate it as we go forward? So part of a portfolio review is how can the institution mitigate? And then what are my go-to tools to be able to manage that type of risk? Credit risk management involves managing the risk of the portfolio of the entire portfolio. Yes, we know that. And then at some point, I need to eliminate, I need to limit, I need to hedge it. I need to get out of it. I need to withdraw from that exposure. I need to shut down. And so to what extent I can do so. And so in some cases, I can't sell off the loan. I can't sell off the exposure. I can't get rid of it, but I can hedge it. I can buy credit insurance, or I can get a guarantee. There's so many different ways that we can do in terms of trying to manage that type of risk. A lot of it is going to start at the starting point. So the starting point is going to be in my portfolio, what is my risk appetite, capacity, and tolerance? That's going to vary based on the type of lender, investor, financial institution that's involved. And then, of course, we're going to go through risk management and risk monitoring. And then at some point, we make a decision about how we're going to handle that risk. Do we have too much risk in the oil and gas industry? Do we have too much long-term risk in the loan portfolio? Do we have too much unsecured risk in the portfolio? Do we have too much country risk in the portfolio? Is a large percentage of loans, are they booked in certain geographies that we're now uncomfortable with? So we've made a decision. At some point, we need to kind of mitigate. And so the risks that we thought that were tolerable are no longer tolerable. Best example or a good example could be loans to airlines. 2 years ago, I might have been comfortable if 10% of my loans in the portfolio are to airlines. I get through the pandemic, that's too much. And so it's 2x excess. It's beyond my risk tolerance. What can I do about that? And so here's some tools that here's some ways that we can sort of mitigate this risk. I can set limits and benchmarks. That means that I'm going to put a limit in terms of industries, countries, currencies, geographies, and so forth. So I'm going to establish a portfolio limit. And so no matter how good, strong that incremental new loan could be, we're going to set a limit and we're going to govern ourselves and by that limit. We're going to make sure that we reduce and maintain that concentration. So I can set limits and benchmarks. I can have policies and guidelines about how I manage that portfolio in terms of long-term risks, unsecured risks, in terms of types of collateral. I can sell off some of these exposures. In certain markets, including in the US, I can sell corporate loans in a secondary market. I can sell them into a securitized structure. I can sell them into an S&P to the extent I can do so. I can do some. I have to sell it at a discount. I might sell it at a slight loss, but I can actually consider doing it. I can look for third-party support. So for some loans in the portfolio, I can go back and ask for a guarantor. I can guarantee. I can ask for some kind of third-party support. I also want to make sure that I analyze these default risks thoroughly and regularly so that I know exactly what the risks are from period to period. I want to make sure I can do this. I can securitize portfolios, and we'll look at this later on. How do I actually securitize? I have a portfolio of corporate loans. I can sell them into an SPV type of structure. I can actually get rid of the risk, transfer that risk into that SPV structure. And then, of course, I can also purchase derivatives. I had early on, we talked about the Tesla case, where if I have a loan to Tesla, if I'm concerned about a higher probability of default, I can in turn go out into the CDS market and buy credit insurance on the notional gross amount of the loan. I'm going to pay a credit spread. That's my premium for that derivative. That's the pricing of that derivative. And the more that Tesla is perceived to be deteriorating, the higher the premium, just like any type of insurance. And I can do that, even though it's, as I said, it's going to require a transaction cost. I can consider. So again, let's kind of walk through some of these methods of how we can reduce credit risk, mitigate credit risk in the portfolio. Number one, discipline at origination. This is at the start. We got to make sure that at the start that we do an in-depth financial analysis, make sure we understand the borrower and the industry and downturn. Now, what that means is that makes sure that we can analyze the company appropriately and also on an ongoing basis to make sure we have the right financial rating, the right risk rating, so that we can measure the default probability and expected loss accurately. And so sometimes it also means that we got to do this updated. I want to make sure that the companies and the borrowers, the counterparties that I'm analyzing, that the information, the condition is an updated assessment. I'm not looking at, if I'm looking at a company now, it doesn't make sense to have assessed the rating based on 2018 numbers. At this point, 2019 could be obsolete. I want to make sure I have the discipline to make sure I do a rigorous analysis and an update analysis to come up with the right rating. Number two, concentration limits. This is what we're talking about by industries, countries, products, currencies, geographies, sovereigns, in so many different ways. We identify concentrations, we accept limits, we execute policies that put limits on what that concentration in the portfolio. I don't want to see a portfolio of bank loans for which 75% could be real estate, or oil and gas and energy related loans could be 60%. That's an excess amount of concentration. So what I'm going to do is going to put a policy in place and say that nothing more than 25%. I got to make sure that if I put the policy in place, that I make sure I adhere to these types of limits. Even though if it means I might have to reject new loans, I want to make sure I am disciplined about analysis, but also disciplined about concentrating limits. Number three is loan sales. That means that for certain markets, there is now a developed secondary corporate loan market. I can go out just the same way I buy loans or buy bonds, I can sell bonds into the secondary market. And so at some point, I might consider transferring at risk or eliminating at risk by selling into the secondary market. Now that's going to be subject to market pricing, market demand, and certain what we call risk retention rules. In some places, a regulator, if I'm a bank or a financial institution, so if I'm regulated, there may be expectations that if I make a loan for 100, that I'm going to keep some of that risk. I'm not going to sell the entire amount. Certain risk retention rules mean that regulators have expectations that you'll keep a certain portion of that risk, let's say 5% in this particular case. So I understand what the risk retention rules are, but if there is a viable and very active market, I make that loan to a Merck or a Tesla, and then based on conventions and market practices, I can consider selling off portions of that loan, transfer the risk to some other lender or investor. Other tools, single name credit default swap. We'll talk about this on another slide. And we've sort of hinted at what this is all about. This is where I can buy credit insurance. I can go to a third party and buy that particular insurance. I will pay a market premium, the today's market credit, market related credit spread for that particular name. And so what that does mean is that I'm not going to eliminate the risk. I'm going to transfer that risk to a stronger counterparty. I'm going to transfer that risk to a stronger counterparty. So if I talk about the case of a Tesla, if I'm concerned about the credit risk of Tesla, I'm concerned that the high probability of default is increasing, I can go to Goldman Sachs and buy a credit insurance. That means that if Tesla goes into default, then Goldman Sachs will make me whole. I can take that loan and Goldman Sachs will pay me 100 cents on the dollar for that particular loan. Now, I haven't eliminated it, but I've transferred that risk to Goldman Sachs because I'm more comfortable with Goldman Sachs's credit rating and credit risk than I have with Tesla. I'm going to have to pay a fee, a market-based premium for that. I'm also going to be subject to the trading requirements established by Goldman Sachs. So this is what we call counterparty trading. And then I could be subject to sort of Goldman Sachs is going to be concerned about me paying that premium. If it's a 5-year CDS, I'm paying for 5-year insurance. And so I've got to make sure Goldman Sachs is going to be concerned about whether I can capably be able to pay that premium over a period of time. Goldman Sachs is going to see that as credit risk with me, and they're going to manage that credit risk with me. Right now, what I've done is I'm talking about my loan risk. I've transferred that loan risk from Tesla to a Goldman Sachs. 5 financial guarantees. I can go to get third-party support. I haven't eliminated the risk. I've actually transferred that risk to a guarantor. And so if the guarantor has a better credit rating than my obligor, I'm better off. And so also if my obligor, my borrower is a triple B and my guarantor is the US government, or it's a sovereign, or it's a company that's risk rated double A, I'm better off with that than I am if I have the loan to a triple B or a non-investment grade name. Number 6 is securitization, and we're going to end this session talking about securitization, some of the steps as it relates to that. That will depend on the asset class. When I said asset class, corporate loan, mortgages, the types of exposure, whatever it is, I've got these credit assets in my portfolio, and then I'm going to take a batch, a bundle, a basket of those assets and sell them into a securitization. The key issue here is that if I sell, does it constitute a complete and thorough and a complete and finished sale? Is there going to be any obligations I'm going to have to go back and repurchase the assets that I have sold off? And so in many situations, we saw this in the crisis in the mid-2000s, banks, lenders, portfolios, they sold off mortgage-related assets, but they in turn had to go back and repurchase and bring those declining and deteriorating assets back onto the balance sheet. So I want to make sure if I sell the assets to a securitized structure, I want to make sure that it's a complete sale in terms of legal. I want to really get rid of that risk as opposed to being obliged to at some point later on to bring that risk back onto my balance sheet. Now, number 7, this is a little bit more complicated. It's like the credit default swap. It's called an index credit default swap. So this requires, and this is a more complicated type of derivative, but this is where I am looking at a basket of names, not just one name, but a basket of names that might be in a certain industry. I use in my CDS example, Tesla. I can buy credit insurance on Tesla, or I can buy credit insurance on a portfolio of names, a portfolio of automakers or industrial companies, or highly capitalized retail names, or in a particular industry, or across the top global names that we're familiar with. So in common practice, many financial institutions will skip buying a single name credit default swap, but they will buy a credit default swap or credit insurance on a basket of names, a basket of names. And that's what we talk about when we talk about the index credit default swap. Now, many of these derivatives can be very, very complicated. What I'm doing now is not really elaborating on the complications, but helping us understand that there are some ways that we can mitigate, whether it's single name exposure or portfolio exposure. Now, what we're going to go back is talk about two other mitigation techniques. One is securitization, which I have described. We'll look at it a little bit more carefully in terms of this particular graphic. This is the case of where a bank has a loan portfolio. And so let's put a number here and say it can sell 250 million in the portfolio. It'll sell it into a SPV, a special purpose vehicle. That it will buy the 250. The SPV will have funded that purchase of the loans by issuing debt into the marketplace. They would issue bonds, AAA, AA, single A, and triple B. It will raise the money. It'll also have an equity portion on its balance sheet, and a combination of debt and equity will be used to buy the 250 million in loans from this particular bank. Now, I'm thinking of this, let's talk this as corporate loans. If this is corporate loans, and if those loans are rated BB or lower, it is what we call a CLO, collateralized loan obligations. So it's an SPV securitization structure. It goes looking for loans to buy from banks so that they can populate into the SPV to create a structure to achieve the returns on those BB credits. And then, of course, pay the lower cost of funding and then achieve net interest earned. So that's what a CLO is. And it is an option for a bank. It is one vehicle for which a bank or a financial institution that has loans and want to transfer that risk, they can do it into that type of securitized structure. Now, that's not to say that a bank can sell corporate loans to other groups. That doesn't have to be an SPV. It can be a bank selling to an insurance company, a bank selling a loan to a hedge fund, a bank can sell a loan to another bank if it chooses to do so, or whatever. So there is, for certain large names, there is a secondary market. In the CLO market, we can have smaller private names. So we can have it for middle market borrowers. We can also have it for mid-size and for large borrowers. The criteria in the CLO market tends to be that CLOs are set up in such a way that they're looking for BB. They're not looking for single A, AA types of credits. They're looking for BB. And the rationale behind that is because, as we had said, the expected loss on a BB credit is going to be much higher because of the probability of default is much higher. So the spread is going to be higher. So there's an opportunity to have a higher return than it is. And then what they're going to do is they're going to issue out the debt, and they're going to issue out and try to get a rating that is investment grade, and they pay very low cost of funding to support a high earning investment portfolio of BB names. So the bank can sell that portfolio in the marketplace, or it can sell it to an SPV. As I had mentioned, most important to the bank is they have to make sure that the sale of the loans does not require at some point later the bank to repurchase that portfolio if the credit quality declines. So worst case scenario, and it has happened in the past, is that the bank sells off its loans and then the quality of the loans deteriorate, and then they're obliged to go back and buy back the loans after the deterioration and then put them back on the actual book. So banks want to make sure, accountants, regulators want to make sure that it is a complete sale, or any type of financial institution that's interested in selling off the loans. What's the probability that they're going to have to bring those loans back, repurchase, and then put them on, and then kind of suffer through that credit deterioration? So the securitization market has had its ups and downs because of the financial crisis in the mid-2000s, but at least for corporate loans, it's still thriving. It's still thriving, and we see that much more evidently in the CLO market, the collateralized loan obligation market. And then finally, what we have is credit default swaps. We've talked about this off and on. I've just now put this in, in terms of graphics and pictures. And so the CDS market is, and I've used Tesla as an example, is that a bank lender or investor wants protection against the default of the credit asset. And so it's transferring that risk to a counterparty. I use Goldman Sachs as my example here. And so if it is a Tesla loan for $100 million, then the bank lender or investor is going to pay a premium to the financial institution on the other side. And that premium is going to be based on our expected loss over a time horizon. Let's assume it's 5 years, CDS expected loss, probability of default that Tesla is going to default over that 5-year period as perceived by the marketplace as of today. Remember, the probability of default perceptions can evolve and change, deteriorate, improve over a period of time. And the credit spread is agreed upon by both counterparties. And then the bank lender investor is going to pay that credit spread percentage measured by basis points, let's say 250 basis points, multiply that by 100 million, and that's going to be the amount that it pays to Goldman Sachs. So what we haven't done is that we haven't eliminated the credit risk. We have transferred it from Tesla to Goldman Sachs. So in effect, I now have a loan to Goldman Sachs, and I can tolerate the rating and probability of default for Goldman Sachs more than if I can tolerate the rating of Tesla. That's based on my risk appetite, and that's why I am buying the credit insurance. Now, there are other things that come along with this as well. Goldman Sachs has credit risk with the bank and lender because they're relying on that premium to be paid, and there's the risk of non-payment of that particular premium. We're relying on Goldman Sachs to perform if there's Tesla goes into default, but Goldman Sachs is relying on us. They're taking the risk and they're relying on that premium to be actual paid. So there are lots of other dynamics that go into this transaction as well. This falls under, at some point, it's loan exposure, but at some point it also is under the heading of counterparty credit risk as well. For our purposes here, I'm introducing as one more method of which that we can mitigate credit risk in the portfolio. Now, I mentioned this as Tesla. An index CD would include not just Tesla, but it would include a basket of names. So that basket could be 25 names, not one name. And then we pay the premium based on the names that are in that basket to the other side of the transaction. If a name in that basket defaults, then the counterparty, Goldman Sachs in this particular example, will pay the full value of the loan, of that loan or that portion of that total basket to the bank or the lender. So that concludes loan lesson number 2 under module 3. We introduce the methods and techniques that risk managers can reduce credit risk and exposures. We walked through the steps that they could use and looked at how they can follow up in using those particular tools. We looked at 2 very important tools that are very popular with financial institutions, and that would be the credit default transaction, and there's the securitization. But we also noted that risk mitigation also is influenced by discipline at origination, prompt and updated financial analysis as well, and setting policies and benchmarks and then adhering through them throughout. I want to make sure that we're disciplined up front, and then we do updated analysis, and then we set these policies, and then we actually comply with the policies that we actually set in place. This concludes lesson 2. This also concludes the course. We've gone through module 1, 2, and 3. And so very, very quickly, what we have done is that we've gone through the purpose of credit analysis, the role of credit analysis, how we can approach credit analysis. Why is it important? Because it helps us determine what the risk ratings are. The risk ratings will help us determine the default probabilities. Default probabilities we use to calculate expected loss. We looked at all the different types of categories and types and products of exposures. That will determine the depth of the analysis that we need to use, but it also helps us to understand the types of structures. Based on different types of structures, we have different types of risk and also expected losses. Remember, if it's collateralized, if it's senior, that has impact on loss given default. And if we lower the loss given default, that lowers the expected loss in the calculation for the loan and also to the entire portfolio. We looked at debt investors and lenders. We looked at their expectations of rewards. We looked at credit pricing. We want to make sure that if we take on this risk based on our risk capacity and risk tolerance, that we want to be rewarded for this. And in the world of credit risk, we're rewarded based on a metric, the credit spread. And that credit spread, of course, is going to be equal to the expected loss, which is a function of probability of default. We also looked at a concept, not just expected loss, but also unexpected loss. That's that worst case scenario with 99% probability. What's the worst that we could lose on this loan or the entire portfolio? I've got a portfolio and I can calculate on average what I'm going to lose, but what about the worst case? And typically, financial regulators would like for the lender, the investor, the bank to have a capital cushion to offset that or absorb that worst case risk. We looked at credit markets. We looked at default frequencies and trends. We looked at market indicators and credit models. The key takeaway there is that we didn't want the markets and models to substitute for our analysis. We wanted the markets and models to supplement our analysis. And we wanted to try to understand and interpret what they are seeing as they're looking at the same risk that we are. Why are they more conservative? Why are they more optimistic than we are? Is there any information that they have that we don't? Or are they quantifying or assessing that same risk that I'm looking at differently than I am? So it can be a very useful way of just sort of complementing what sort of in a complementary fashion of the analysis that we do. We talked about credit deterioration as opposed to credit default, and we introduced the concept of credit VAR. It does not measure default probability, it measures credit transition. What's the probability that a rating will decline a notch or two over a certain time period? Or we look at a credit VAR in terms of what's with 90% probability, what's the worst do we expect that transition or decline to be? And then lastly, we looked at portfolio management, and we've talked about the essential concepts of portfolio management: concentration, correlation. We looked at all the complications that could be in terms of our efforts to try to quantify correlation. We understand how it contributes to a higher unexpected loss in a portfolio. But what we need to understand is what approach that we can take to look at correlation. So we didn't really come up with one approach, but we understand the complications as long as we can understand the impact and then at least try to address correlation in the portfolio. And then the last thing we did, we kind of rolled out our toolbox of credit mitigation and went step by step of what are some of the things that we can do if we've reached a point in time in terms of how we come up with that actual rating. Thank you very much. This concludes module 3, and it also concludes credit risk management.